never had a situation historically where the Fed has not begun to normalize rates and there's an inflation concern in the markets.
I do worry that after a 2021 boom, we're going to slow perhaps more than people expect next year.
People, they don't like inflation. This is true, but they will tolerate it.
We have a very different set of both market and monetary circumstances and economic circumstances right now.
Make no mistake, there's nothing supernatural about the U.S. economy. We've just given it a lot of extra adrenaline to run on with the fiscal stimulus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowicz. Equity futures are down about 0.5% on the S&P 500. We're off 21 points. And finally, guys, I think we're talking about it in the Fed minutes. That must be the most overused phrase of the last 24 hours, Tom.
Yeah, I'm going to let you guys cover that. To me, it's no big deal. It's just the beginning of talking about it, and they will wait for the economic data, John, and most of that will be GDP, that presumed tail-off that we're going to see in GDP. Will that occur? What I'm looking at is market stasis, John, which is frankly comforting after what we saw yesterday.
Elisa, are we prepared to call it no big deal?
No. I would say that this is actually a big deal because we're starting to get the sense that people are getting a little bit more concerned.
Across the kitchen table, no.
I'm not going to mince words. I think that it was significant. I think that they are beginning the conversation. How quickly they're going to accelerate that conversation, how fringe this conversation really is versus the actual voting members, all up for debate. But still, we are talking about, thinking about, John, and this is a big deal.
Who is talking about it? I think that is key. Who is talking about
true.
it?
No, you're
and
fair.
I've said it's often the case that the minutes are a platform for the hawkish minority on the Federal Reserve. And to some degree, I think yesterday was no different, Tom. Though we have to say it's more than a couple. It's a number. So it's more than just Kaplan and Bullard. That's notable. I also have to say, though, this predates the payrolls report. And in that paragraph that everyone's been quoting for the past 24 hours or so, it discusses a rapid recovery, the continuation of a rapid recovery. I don't think the payrolls report speaks to a rapid recovery in the last month in this country.
I'm just not going there. I'm going to the data and what we see on the data, and they will act when they act. And with that, of course, is the gaming of the market and trying to guesstimate where we are. I'd focus on the retail earnings numbers we saw yesterday, John. They were absolutely extraordinary, and importantly, that good guidance. Granted, that only gets you out 3 months, maybe 6 months, where in the Fed parlor game, we're trying to get out 1 year or 2 years.
Earnings season has been pretty tremendous. And Lisa, the guide, the look forward has been pretty decent from these retailers in the last couple of days.
Yeah, and this speaks to the dynamism that, frankly, other central banks around the world are responding to. And, John, you've been out front about the ECB and how they may be the more interesting meeting. What happens if other developed market central banks start moving ahead of the Fed? What does that do for the Fed? What does that do for a Fed that is more aware of some of the financial stability risks in tandem with the ECB and others?
What I thought was really strange about the ECB's financial stability review was the following quote. A 10% correction in US equity markets could therefore lead to a significant tightening of Eurozone financial conditions, similar to around a third of what we saw in the coronavirus shock of March of last year, or March of 2020, Tom. That really gets your attention. Just a 10% correction would lead to something that vicious in Eurozone financial conditions.
Well, yeah, in Europe you're seeing it. But, John, let's go to the yields. I know you're going to do this in the data check. The big thing the last 2 days, folks, is not Bitcoin. It's that the real yields have finally begun to nudge up. It's tangible to see a lesser negative 10-year yield and to see the march of the German 10-year yield negative 0.094. John, published moments ago, this is Oliver Chen on Target, targets leading investments in store labor with starting wages at $15 an hour is resulting in high engagement. I mean, that to me is more germane than the policy game of the Fed.
We're going to see much more of that, and we'll have this debate through the morning. Let's get to the price action this Thursday morning. Good morning to you all. Your equity market down 22 on the S&P. We decline 0.5%. Tom talking about the real yield. Here's the nominal. Yields in a single basis point to 166.08. In a commodity market, talk of sanctions being lifted maybe in Iran. We'll talk about that a little bit later. 62.43 on WTI. And euro-dollar, Lisa, just south of 122 at 121.87.
Here's what I'm looking at today, in addition to, of course, market response to the talking about, maybe talking about tapering, in addition to a slew of other events. 8:30 a.m., we get the U.S. initial jobless claims. We used to peg our time to these jobless claims. We used to think that they were significant. Now it is a question. I might be more interested, frankly, in the Philadelphia Fed business outlook, especially with respect to manufacturing, supplies, supply chain shortages, et cetera, because the initial jobless claims have been so messy. Still expect them to continue a downward slope as people start to get back to work after the pandemic. At 1 p.m., interesting to watch this $13 billion auction of Treasury inflation-protected securities from the Treasury Department. Basically, how much demand is there for investors looking to hedge themselves against rising inflation expectations? Yesterday, Kathy Wood of ARK Investments came out and said that she was more worried about deflation in the U.S. than inflation. The raging debate continues. And then today, the U.S. Secretary of the Chamber of Commerce, Gina Raimondo, is going to be holding a summit on the shortages in the semiconductor chip industry. She's going to be having a host of CEOs from the biggest companies. The key issue here is what is necessary to bridge the gaps that we continue to see with a record wait time currently for people to actually get the chips that they order, John. A huge issue.
Tremendous respect for Kathy Wood, but do you think she was talking her book a little bit?
No,
I mean,
no.
Is the sky blue? Of
Deflation,
course.
Deflation in America, low yields.
Hold on a second.
Up in growth equities.
But there is a question, and she was pointing to the recent decline in commodity prices as perhaps a signal of what's to come. What happens if the imbalance in the economy due to the pandemic, with people buying more goods than services, leads to an overproduction of certain key goods that then leads to price deflation in the future? It's something people are talking about. I would argue maybe disinflation is perhaps the better term than deflation outright, but still an interesting point to notice nonetheless.
Go on, TK.
Just don't get me going.
Please, go ahead.
You've got something to say.
Just talk in her book. Yeah. I thought, Carol did a great job trying to tackle the moment. In Kathy's defense, this idea of showing your portfolio, whatever it is, daily, weekly, whatever, is really difficult. It's just really a distraction.
Jobless claims 450. That's the estimate.
Yeah, I'm glad you brought it up. I'm glad Lisa brought it up because, frankly, folks, I'd forgotten it was Claims Thursday. John, it's the most elegant chart in economics. If you want to define a trend, it's truly an elegant chart. It'll be amazing to see if that constructive trend continues.
Hopefully it does. The number drops at 8:30 Eastern Time. Let's bring in Russ Kostrich, shall we? BlackRock Global Allocation Fund Portfolio Manager. Russ, are we talking about it? And should we be talking about it this morning? How significant is it?
We're going to be talking about it one way or the other. Look, I think this is important. The Fed is likely to start to shift their policy stance in the coming months. It's not unrealistic to think you begin tapering in Q4. Having said all that, despite all the ink being spilled, a couple of points. Long-term yields have actually remained remarkably contained. We've never taken out the high from back in February and March. Bond market volatility is down significantly from where it was, again, back in February and March, despite the biggest inflation print in 40 years. So this is a big deal, but, the wheels are not coming off the vehicle yet. And I think that's important to realize. We still have a 165 10-year. Bond market volatility right now is still modest. So as of today, that helps explain why stocks are only down 3-4% from their high.
I mean, the correction has been a non-correction. Russ, can you buy the big techs here? Have they been unloved for a long enough time where they're actually a relative value of relatively unloved?
I think there are some opportunities in the big tech. Just to be clear, what we're talking about, I think it is the mega cap, high quality tech. It's not necessarily the more speculative names, the ones where earnings are 5 or 10 years out. We've actually been trimming those from the portfolio. But yes, if you're talking about high quality tech, it may underperform over the next 1 to 2 quarters if we get these gaudy GDP numbers and the cyclical trade continues. 2-3 years out, I think you want to own them. You want them in your portfolio.
Meanwhile, as we talk about portfolio construction, Russ, there is a question of whether treasuries can provide truly a hedge for equities at this point, especially given the negative correlation that's gotten it, by one measure, to the most since the 2000s. What's your sense right now, early 2000s, I should say, what's your sense of how hedge-worthy treasuries really are?
Right now, not much. The reality is things have changed. And if I look at stock bond correlations, everyone knows they're ticking up. What's been less discussed is the fact that equity market volatility has remained elevated compared to bond market volatility. That wasn't a couple of months ago, but the reason that's important, and the reason it's affecting the efficacy of the hedge, is that tells you how convex a hedge it is. What you're seeing is even in these days when the market is down a couple percent the way it was last week, either bonds are flat or they're up a little bit. They're not giving you that big movement that made them such an efficient hedge the way they were a couple of years ago, and that's a big change. We don't talk about that a lot. We talk about Bitcoin. We talk about the Fed. If you're building a portfolio, the degradation and efficacy of bonds as your primary hedge is a big deal.
Just to be clear here, Russ, you were the first person to mention Bitcoin on this program so far this morning. 10 minutes in. Just to be clear about that. Russ, just finally and quickly, are you still nursing that cash position? Do you still sit on that going deeper into summer?
We do have the cash position. Again, it's the flip side of that being very underweight duration. Everyone's got a volatility they look to manage their portfolio to. In the absence of duration, you need other hedges. Part of it is cash. There are other things as well. There's vol as an asset class. There's FX pairs. But in a world where you're not getting that convexity from duration as a hedge, you're going to run with more cash.
Russ, thank you. Our best to the team. Russ Kostrick there of BlackRock, the Global Allocation Fund Portfolio Manager. Your 10-year this morning at 166. And to Lisa's question, just a conversation, Tom, about the substitution for duration. If we get that risk-off move, where do you get the protection?
Well, the bond dynamics right now, that we throw these words around, John, duration, convexity, and the rest of it. It's still a mountain of cash that's out there, including what Russ has. Yeah. A mountain of cash, given absolutely original fiscal and monetary policy. I'm not sure the bond market sends signals I'm familiar with.
It's pretty simple at the end of the day, and we can make it simple without the jargon.
Look at the real yield.
On days when things are bad, what is green on my screen? Or what is not red? And Lisa, right now, Treasuries can't guarantee you that.
Yeah, Liz Ann Saunders actually came out today. I thought this was really interesting, of Charles Schwab. And she said the rolling 60-day correlation between 10-year Treasury yields and the S&P 500 is in negative territory, and about the most negative since the mid-2000s, just highlighting this lack of protection that Treasuries really are providing.
It's a big challenge right now. We're coming in a basis point on a 10-year. We'll continue this conversation with Evan Brown of UBS Asset Management. We'll do that at 7 a.m. Eastern Time, and at some point, someone else might mention the B word. Equity futures down 20 on the S&P.
New drinking
down
game.
Down 0.5%. Yields in a basis point on 10s at 166. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz, Jonathan Ferro.
I didn't sell the Doge.
Equities pulling lower. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In Iran, President Hassan Rouhani says a broad outline has been reached to revive the 2015 nuclear deal and remove economic sanctions. Rouhani says differences remain over some issues. A top EU official said yesterday that Iran and the US were close to a deal. Talks have been going on in Vienna. There are media reports that Israel and Hamas are near a possible ceasefire deal. That's after President Biden urged Israeli Prime Minister Benjamin Netanyahu to wind down the conflict. According to the New York Times, the deal would unfold in stages. Israel would quit attacking the Hamas infrastructure, whilst the Palestinian militants would halt rocket attacks. And China has released the first images from its Mars probe. The spacecraft landed on the red planet Saturday. It's carrying a rover which will explore the surface near the landing site. China is the second country after the US to send a rover to Mars. And the co-founder of Apollo Global Management, Josh Harris, has decided to step down from his day-to-day role. Harris wants to return to his roots as an investor and entrepreneur. He will continue to serve on Apollo's board and on the board's executive committee. And the Democratic-controlled House has voted to create a commission to investigate the January 6th insurrection at the Capitol. 35 Republicans broke ranks with their leadership to support the probe, but the legislation's fate in the Senate is uncertain. Republican leader Mitch McConnell is opposed. Democrats would need 10 Republican senators to vote in favor of the investigation. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
if Russia acts aggressively against us, our partners, our allies, we'll respond. And President Biden has demonstrated that in both word and deed, not for purposes of escalation, not to seek conflict, but to defend our interests.
That was Secretary Blinken there from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Carrying you down to the opening bow 3 hours away is the price action. Equity futures down 22. We decline 0.5%. In about 2 hours and 12 minutes, we'll have jobless claims in America. The estimate so far, a drop back to 450. We want to see that continued, a continued drop in claims. In the bond market, yields lower by about a basis point, 165.74. And in foreign exchange, Tom, muted here on euro dollar, up about 0.1%. Stronger euro. Euro dollar 121.84.
Yeah, John, a good litmus paper for this is the VIX, the volatility of the SPX, and at a 23.21. It's midway between the 27 angst that we saw a number of days ago and the Nirvana under 20. That's sort of where we are right now at 23 level. What is the angst in Washington? Jet Fitzpatrick joins us now, Bloomberg's Washington social reporter. Jack, I'm absolutely fascinated by the symbolism of 35 Republicans on this commission on January 6th. Not so much about January 6th, but the symbolism of 35 Republicans crossing the aisle to join the Democrats, or did they not cross the aisle? They just joined the Democrats. What's the nuance there?
Well, it's interesting that there was such a substantial number of House Republicans who did end up joining the Democrats and supporting this bill at a time when Senate Minority Leader Mitch McConnell said he is now against this. So this is going to go to the Senate. And now that leadership has taken a clear stance against the bill, despite the fact that it would create a 50-50 commission in terms of Republicans and Democrats, it seems doubtful that such a high number, equivalent in the Senate, number of Republicans would come on board if you've got leadership starting to whip against this. Yeah. So that 35 number may be the high range because we're seeing movement in Washington where Republican leadership comes out more strongly day by day saying, we really want rank and file members to oppose this.
But as the Republicans reset, are those 35 Republicans seen as abandoning the Republican Party, or do they just decide to support the Democrats? Which is it?
That it could definitely be a controversial move. This isn't the kind of bill where you get to vote with Democrats and there will be no repercussions. The major issue in primaries going toward 2022 will likely be, did you stand with former President Donald Trump through everything he wanted you to stand with him for? And Trump does not want this commission. At least that is the expectation among many Republicans, that Trump doesn't want this commission to go forward. Spotlight on January 6th does not help that faction of the party. So to see almost 36 Republicans side with the Democrats on this, that's a significant vote, and that could be the kind of thing that comes up in their primaries.
Tom, I got to say, we talk all about these proposals and these measures and these initiatives, and we wonder what actually will get passed, what actually will have consequence for markets. One thing that a lot of people are saying will have consequence for markets is the B word. I had to bring it back, Bitcoin, and some of the volatility that we've seen, not only with the price, but also in some of the platforms that transact some of the crypto assets. Can you give us a sense, Jack, of how much urgency there is on Capitol Hill to create some sort of regulatory framework for Bitcoin, akin to what we've heard from China and akin to what a lot of people are asking for, given the recent volatility that we've seen in the price, as well as shortages and outages in some of the platforms?
Yeah, we're still kind of in the early stages of that conversation in Washington because that regulatory conversation is not in the top level of legislative priorities that Biden has been pushing. It would probably have to, if you're really looking for legislation that could become law, it would be after we get through all of the infrastructure talk and the human infrastructure talk and even the climate issues that Democrats want to bring up. It is the kind of thing where you're hearing some members get more and more vocal about some oversight on this. But in terms of translating that into a bill that could get a markup and actually have a chance of becoming law, we're not quite there yet because we're still on the top legislative agenda of the Biden administration.
Jack, when Biden came into office, one of his promises was to restore a view that government could work, that government could actually get things done and make proposals that could actually make the economy, make people in a better place. Is there a sense that he has changed anything on Washington, in Capitol Hill, based on the progress with some of these bills, or does it seem like the machinations of these negotiations are just stuck in the same trends that we saw pre-Biden?
Well, if you ask Democrats that kind of question, they would say the initial stimulus was a big step forward on that. There was a significant campaign promise that people would get $2,000 checks. They got $1,400 plus $600 checks, which basically counts. Democrats won the Senate largely because of that kind of promise, because of the race in Georgia, and ended up delivering on that. So even if that may have seemed like a bit of a politicized giveaway, that's a significant thing for the president to come in and very quickly back up a campaign promise. He did also promise more bipartisanship, and there seems to be some progress there with an infrastructure bill. We're maybe halfway through that process, so it could still fall apart. But politically, yeah, a lot of what we've seen that has pulled well for Biden has probably pulled well because he's managed so far in the early stages to back up some significant campaign promises.
It gets harder from here, that's for sure. Jack, thank you, sir. Jack Fitzpatrick there, Bloomberg government reporter down in D.C. I'll be catching up with the chair of the Council of Economic Advisors, C.C. Rouse, Dr. Rouse, a little bit later this afternoon, Tom. We're going to talk about the philosophy of the administration. I think we've got a real clash of philosophies across the country right now as we continue to count up the states in America that have removed that additional UI. Of course, all of them Republican states, Republican governors who believe in their position, in their view, for their states, they believe that additional UI is holding back employment.
I love that, John. That jargon is great there on the unemployment insurance or whatever it's called.
Thank you for
John,
translating.
Thank you. It's absolutely unreal. We forget how original this 2021 is. The only analog we have in the modern day is 1947, 48-ish, I'm going to suggest. And it's not even that, John. This is just, when you speak to this wonderful guest today, it's just original where we are right now.
I think that's where I'll begin. Lisa, it is a struggle to find a historical parallel for the moment we're in.
And it's a struggle to understand what's causing what, right? The fear that possibly some of these enhanced unemployment benefits are keeping people out of the workforce. The data on that, the studies on that are conflicted, and it's too early to really determine one way or another. Anecdotally, that's what businesses say. But how do you respond to that when there still are people who cannot get back to work, John?
Yep.
This is the struggle.
There are clearly childcare issues in the mix as well. For many people, we're still in a pandemic. Equity futures this morning, they do decline. We're down 18 points on the S&P 500. We're off by about 0.4%. In the bond market, yields are lower by about a basis point. Just a break of 166 here at 165.91. From New York City, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. For our audience worldwide, counting you down to the market open 3 hours away, this is Bloomberg. From New York City for our audience worldwide, good morning to you all. Thursday morning, here's the morning price action. Down about 18 points on the S&P. We declined 0.4%. Similar story on the NASDAQ. Similar story on the Russell. The small caps underperforming, relatively speaking, down about 0.6%. For all the talk about tapering, switch up the board and get to the bond market. Yields were higher by what? 3 basis points. That's a taper tantrum. I don't think we're talking about it just yet, if that should move on a 10-year, 3 basis points. Right now, 166 on 10s. Yields come in about a basis point. And for many people, this was sensible. If you think about a number, what is a number? OK, it's more than 2 or 3 on the FOMC. That's notable. Then you think about the words rapid recovery, the continuation of a rapid recovery before we talk about this. This came before payrolls. Then you look at payrolls, and that was not rapid, was it? I think we can make that argument. That's pretty clear. And we keep going back to the same story with the Federal Reserve minutes. It has always been, when you have a dovish Federal Reserve, that there is a platform for the hawkish minority. And I think that's what you saw yesterday. The hawkish minority masking their insignificance through anonymity. That's the bond market right now, and I think everyone got the joke. 236 on 30s at the moment, yields unchanged. We can talk about the taper story a little bit later. It's a story for next month, the month after that. It's going to be an evolution of the language. The Federal Reserve's not going to jump from one point to another just like that after the huge communication effort of the last 12 months. Switch up the board and get to foreign exchange. Euro dollar looks like this, 121.90, positive on the day by about 0.1%. Philip Lane, the ECB chief economist, out this morning. Talking, and Tom, he said he does not put much weight on this inflation narrative. That's the ECB's position. I'm fascinated by this ECB meeting in a couple of weeks' time.
That's the most important quote we've had this morning, John.
Yeah,
that
there's going to be a bit more pushback
important
from the ECB, Tom.
Well, but I'm going to go to Jan Hatzius and many others on market economics on Wall Street, John, who agree with Dr. Lane that, you know, you're going to see a spike up and then we're going to damp down, come right back down to something more normal.
So, TK, we've touched on this a couple of times, and I do think it's really important. That's Philip Lane, and he's in line with the core of the Federal Reserve on this view as well, that much of the price pressure we're seeing is transitory, not just in the United States, but worldwide. The issue that the ECB has, that the Federal Reserve does not have right now, is there isn't a framework that the Governing Council has agreed to in the same way that the Federal Reserve has. And I remember hearing from Governor Carney years ago when he introduced forward guidance into the UK and to the Bank of England. And even though for many people it didn't go so well, one thing it achieved, it just kept the hands of policymakers tied and kept the committee on the same page for an appropriate amount of time. The ECB doesn't have that. Those hands aren't tied, and that's why you get that hawkish sound just a whole lot more, even though maybe it's not warranted. And that's what you might hear more of in Europe in the coming weeks and months.
John, I need a briefing right now. You're the only one out of 19,000 employees who can do that. Sonali Bassett called me up, John, and said, can you please ask John for a Crystal Palace briefing? I mean, Josh Harris owns the New Jersey Devils.
Briefing.
They're like at the bottom of the pile of the National Hockey League.
To be clear here,
is Crystal Palace, like, they lost to Arsenal 3-1.
I'm sure, Tom, there is a Crystal Palace fan in the 19,000 employees that we have, and I'm not one of them. So I'm probably not your guy.
Are they like on the edge of relegation? Or are they like...
Relegation's done.
That's done?
That's done. That's sorted.
So they made it through that?
Bottom three sorted out.
Okay.
We need to talk about your tots. Is that what you're avoiding this morning?
No, I don't want to talk tots. Sonali and I are stressed out about
a Palace
Crystal
fan.
Palace, and yeah, she is.
When was Sonali a Palace fan?
When Josh Harris told her to be one.
What are we doing this morning? Euro dollar 121.89. Go on, TK.
Very good. Sonali Bassett joins us now as Mr. Harris exits at Apollo Management. He's got the Devils. He wanted Aston Villa. He's got Crystal Palace, and now he exits. Why is he leaving the fun of Apollo Management?
To focus on all of those things. We know that he made the pitch to be CEO of Apollo as Leon Black started to step down, but that's a role that his co-founder Mark Rowan had gotten. So you're seeing, Tom, in just a couple of days, the fabric of Wall Street, the top leadership at two major firms start to take shape much faster. So really, we're seeing succession on Wall Street play out.
Forget about this. I want to get out front of all of market Wall Street. The pandemic's over. There's a little bit of action in Midtown Manhattan. We've got Bloomberg getting more people. The food court's actually populated. There's a line at the coffee machine. Do you know what that coffee machine costs?
I don't.
The Grauer coffee machine is like $300,000.
But a lot of people made a lot of money by betting on distress last year, and that opportunity's over.
That opportunity's over. And so the key thing here is now going to be a movement of management like we've never seen before.
We're seeing it. When was the last time you saw changes this fast and hard, Tom?
Exactly.
And so it's time to change jobs. Honestly, we were talking to recruiters all week. It's time to ask for more money from employers as people are starting to change jobs. But, you know, this move at Apollo really is a landmark in a firm that has grown to more than $400 billion in assets, really filled the holes as the banking system started to step back in the last decade. And, you know, Bloomberg had reported just weeks ago that this was going to be possible. It happened much faster than expected. So this is at the top levels, guys.
Sonali, just taking a step back, is this your garden variety moving around for a bigger paycheck, or is there something larger at work here, particularly with the private investment management firms, given how big they've gotten and how much more mainstream and, frankly, attracted more scrutiny that they have become?
It's a great question because on one hand, this is a very Apollo story, right? There's been a lot going on there, right? As we know for the last couple of months. But, you know, with private investment firms, they've been looking for the next generation for decades, for years. we're also seeing it at the banks, Lisa, right? We've seen Jane Fraser just recently take over. She has her guard in place. So it's not just the private equity firms.
Sonali Basak, thank you so much. Greatly appreciated this morning. Right now in London, Roger Bootle joins us. He's with Capital Economics, our chairman. Very important work in the Telegraph as well. Roger, I really have to ask about the churn that we're seeing right now in this great economy. The Philip Lane comment that John Farrow just had is so important. You're Ambrose Evans Pritchard of the Telegraph writing up inflation worries. Do you have inflation worries?
Yes, I do, actually, and for the first time for quite a long time. Now, saying that I've got inflation worries, and I don't think it's going back to the inflation of the 1970s, but it concerns me that a lot of people in the markets and central banks and governments are becoming, I think, a bit complacent about this. Now, at the moment, of course, we're seeing, particular prices going up, and as some of your people have been saying this morning, those effects are going to fade out, frankly. But I think the bigger issue is the stance of policy. All this money sloshing around, these incredibly low interest rates, I think we risk an inflation surge.
Roger, is there a place around the world where you think that complacency is more concentrated? A region, a country, a central bank?
Well, I think the danger, let's put it this way, the danger is greatest in the States because the economy was not that hard hit. I think it was hard hit by the pandemic, but not as hard hit as countries in the Eurozone or the UK. And you've had this massive, absolutely massive fiscal stimulus. And the money supply has grown substantially, and you're already at 4.2 on the latest figure for the CPI. I think you'll see inflation readily at 5%, and I don't think it's going to subside that easily. At the other end of the spectrum, I think the Eurozone is not facing that much of an inflationary danger. Of course, there'll be the spikes as a result of commodity prices and energy prices and so on. But I don't think you're going to see anything like 5% in the Eurozone. And the UK is, I think, just about in between those two cases.
Do you think there's some financial stability risk here along with that?
Yes, I do. The big question is what central banks do. And if they don't do anything very much for some considerable time, then I think the risk is that they're going to be bounced into jumping interest rates. And then that has a very substantial stability risk. I think the appropriate thing, once we're clear that the economy really is pretty strong and the inflation figures are picking up, I think central banks should start to edge up interest rates pretty soon.
Roger, what's going to be the impetus behind higher wages in the United States, which a lot of people who come on this show say is sort of a predetermining factor to longer lasting inflation, as you're predicting?
Well, it depends how strong the economy is. And all the signs are that the economy is going to be very strong. And that increases the bargaining power of labor. Now, it's not going to appear necessarily immediately, but it does happen when the economy is very strong. There's a shortage of people. Wages are bid up. But you're right to say that you can't have continuing inflation going mad for a long time unless wages pick up. But I think they will. And after all, wage earners will have to pay higher prices in the shops, and that will affect their living wage, and they'll want to get some sort of compensation for that. This is how inflation starts. And by the way, in the past, when inflation's got a bit out of control, it's always begun with people saying, oh, these are special factors, don't worry, it'll fade out. And with the central bank saying, oh, no, we're taking a relaxed approach. And then, of course, a bit later down the line, they find out that it doesn't fade out.
Roger, I'm sitting here trying to make these two views coherent, this idea that we could get inflation that rises to 5% and stays there for a while, and the idea of a financial stability risk that torpedoes markets and causes perhaps a return to pressures on the economy. I mean, can you square the trajectory of the inflationary push and perhaps the market crash that subsequently results?
Yes, I don't think it's the inflation itself that actually poses the risk to markets. Obviously, it's a risk to bond markets at these incredibly low yields. But as far as equities are concerned, I don't think it's inflation itself. Obviously, equities are then sensitive to whatever happens in bond markets. No, the risk is from policy. Now, of course, if the policymakers decided they're prepared to tolerate 5% inflation for a bit, then fair enough, that doesn't materialize. But I would presume that at some point or other, 5% would be seen to be too high. Now, the Fed has altered its target. It's prepared to tolerate inflation. Well, it hasn't said explicitly, but 3%, perhaps 4% for a while, for a few years. But if this gets bedded in, then I think it has to act. And then if it acts by raising interest rates by anything other than a tiny amount, you've got to wonder, in the financial conditions in which we've been living, with very high asset valuations, huge amounts of debt, you've got to wonder what the fallout from that will be. And I think that will be quite ugly.
Roger Bootle, very quickly here, have we forgotten the joy of nominal GDP? I mean, you and I are fossil enough to remember the bright lights of nominal GDP really helping corporations, the corporate spirit, the business spirit, if you will. Have we forgotten that a little bit of inflation could be a good thing?
Well, I hadn't forgotten about that. The trouble with a little bit of inflation, it's a bit like being a little bit pregnant. Things tend not to stay that way. Well, I would. They tend not to stay that way. Now, in some conditions, in the 50s and 60s, we had inflation 2, 3, 4%. It didn't get out of control, at least not for a long while, but then it did get out of control. I think you're right in the sense that we obviously don't want an economy that's flat on its back with zero inflation, let alone deflation. And if we've got 2%, that's perfect. It's probably good, better than having 1% or 0, maybe even 3 for a few years is perfectly okay. But once you get to these higher levels, then I think you do begin to get difficulties emerging. And so far, of course, central banks have not wanted to accept something like 5%. Maybe they will.
Not the conversation I expected between the two of you to round this up, but we'll leave it there. Roger, thank you. Roger Bootle there.
We're getting tons of mail in.
Chairman and founder. I bet you are, but it's not the good kind either.
A little bit pregnant?
No, here's someone from London.
TK put out on Twitter yesterday.
This is someone from London.
That was gold.
Anne-Marie with no E saying that she laughed for the first time in 2021. Yeah.
Tom, can I just say, when we started doing this a number of years ago and someone crazy enough put us together and you knew nothing about football, English football, how on earth do you know who owns? How do you know? How on earth do you know everybody who owns each club? I had no idea who owned Crystal Palace.
Because, John, I'm ready.
Google.
I'm up at 2 a.m.
Google.
Roger Bootle's a Telegraph. Telegraph football.
Telegraph football.
Yeah,
that's how you worked out who owned Palace, just like that.
Yeah, and I'm worried about Harry Kane. I mean, the thing 4 years ago where Harry Kane was going to go to AC Milan, why can't that happen again? Seriously, John.
I don't think we're the club that he's looking for, Tom, unfortunately.
Oh, come on, he's got to go. Seriously, he's got to go to the biggest paycheck.
Yeah, and that's not going to come from us.
Where's it going to come from?
Else. Don't know. It could come from Paris. Could come from Spain.
Interesting. Paris.
Could come from one of the Manchester
PSG,
clubs.
Isn't it?
Maybe Chelsea it is.
That's PSG.
Yeah.
So
very well read in, Tom. Tom Keene, Lisa Abramowicz, Jonathan Ferro. For our audience worldwide, equity futures are down 15 points on the S&P 500. We are declining 0.4%. Your bond market is at 166.25 and down about a basis point. For our audience worldwide, this is Bloomberg Surveillance.
There's going to be a lot of differences in how schools reapproach in-person learning in the fall. We'll look to those numbers of incidence and prevalence to really think about if incidence falls below a certain amount, will masks come off? Will kids be fully back in person? Will there be online options for kids who either can't get vaccinated or whose parents don't feel safe having them in school? I think it's going to be a patchwork of a lot of different strategies.
That was Lawrence Sauer there, Johns Hopkins Associate Professor of Emergency Medicine from New York City this morning. Good morning, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Counting it down to the opening bell, equities down about 0.4%, declining 16 points on the S&P 500. Yields lower by a single basis point to 166.08. A little bit later this morning, 8:30 Eastern Time, jobless claims in America. Then on the Fed Speak lookout, following the minutes yesterday, the Dallas Fed President, Mr. Kaplan, Lisa pointing this out a little bit earlier, 10:30 Eastern Time. We'll hear from the less dovish member of the FOMC. Should we put it that way, instead of maybe calling him a hawk?
Yes. Yeah, I think he would like that. He would prefer that.
He'd prefer that characterization.
Within the dynamics of the news. And John, the PMI numbers that we get coming up here, is it a big deal?
I think the PMIs are, yeah. Just to get a continued read on what's happening in America. Yeah. Just a quick flash read of things, both in Europe and the United States going forward from here.
Right.
And it's shown what we have seen more accurately, which is great demand and a real problem meeting it. Supply. pressure, labor cost, etc.
John, the problem is the generational gap here in team surveillance is outrageous. Riley from St. Louis just emails a banner, which, she wants me to run it. She's in my ear, folks, going, we've got to put that up. It's critical. We need to brush Jennifer Nuzzo aside.
What's the
banner?
banner?
Let's put up the banner right now.
What is it?
Elon Musk has tweeted. He's tweeted out. It's a break exclusive on surveillance. He tweets. I can't believe I'm reading this. Musk tweets photo of paper Doge money.
Okay.
Can either of you translate that for me?
I'm looking at his Twitter account right now. He says, how much is that doggy in the window?
Basically, anytime he mentions Dogecoin has been a positive for Dogecoin, which is a joke currency, at least originated as a joke currency from Roblox.
Why are we doing this?
I have no idea. Tom?
Because it's an insane time. BitDog right now, folks, 40,000 is a handle, 39,000 earlier. Jennifer Nuzzo goes, why are we doing this? Dr. Nuzzo is with Johns Hopkins Center for Health Security and senior scholar. And at one point at gunpoint, she had to study the reality of the fear of measles. Yes, the mumps, rubella, and the rest. But in the early 1960s, it wasn't polio that you were scared stiff of. It was measles. And then out of the Fay School in Boston, there was a measles vaccine. I remember that relief. Jennifer Nuzzo, are we there right now where it's like the Fay School in Boston? We've got a vaccine and we're going to see a societal relief?
I hope so. I mean, these vaccines that we have are really great. We got so lucky with them. I hope people see them as something that can relieve them and to relieve the stress and worry. Unfortunately, I think people aren't, not everybody is embracing them with as much enthusiasm as I am and as I think people should be. But it's a pretty great discovery for us to have.
Doctor, why are vaccinated people still getting tested?
They shouldn't be. I feel strongly about that. They shouldn't be. I mean, the CDC says that they shouldn't. If they have symptoms, sure, get tested because, we do know that there are some breakthrough infections. It's very rare. But we really only care about the people who are clinically going to have, effects like symptoms to spread it. We know that people who are vaccinated are very well protected against infection. A few people do go on to become infected, but without symptoms, it's also very hard to transmit it because it's likely that their levels of virus are so incredibly low. So certainly they shouldn't be using a very, very sensitive test like PCR on people who are vaccinated and have absolutely no symptoms.
Is that why you feel so strongly about it? It's just a resource issue?
Not so much a resource issue. It's just you're going to pick up a whole bunch of stuff that probably is not meaningful from a public health perspective and cause a lot of concern and chaos. A colleague at Harvard, Michael Mina, has been arguing that if you're going to do anything, you should use an antigen test, which is less likely to pick up the people that have the remains of viral RNA in their noses, and focus on the people who are likely to be contagious. And my sense is if you did that, you would probably those people wouldn't test positive because they're not likely to transmit.
Dr. Nuzzo, do you agree with the view of Amish Adalja, the doctor at Johns Hopkins, who says it is time to move to a post-pandemic reality where COVID-19 is treated like the common flu?
I think we're getting there. I mean, there are still people who have not had a chance to get vaccinated. There's still people who got vaccinated on the first day that they were eligible and are not yet fully immunized because, that process, depending on what vaccine you get, may take 6 weeks. But I think we are absolutely heading there. And once we get to the point where any adult who wishes to be vaccinated has had time and opportunity to get it, which I think we're headed to soon, I do think it changes the dynamics of the response. Now, people are going to say, well, what about my kids? And I completely understand that. I've got 2 kids myself who are too young to be vaccinated. And I think we have left parents, unfortunately, with the perspective that those kids are completely unprotected because they haven't been able to be vaccinated. They would be more protected, sure, if they were able to get vaccinated, and I expect we'll see vaccines be available in the fall. But you can protect your kids in other ways. As adults get vaccinated, the cases will drop in all age groups, and that protects kids, including those who are not vaccinated. If you're bringing your kids to a crowded indoor space, they can still wear a mask. I don't think they need it when they're playing on the playground by themselves, but certainly if I took my kids to, Target and it was really crowded, I would make sure they would wear a mask. And you just keep your distance. You try to stay outside as much as possible. I think, things are going to start to feel much better in the summer, but it's also contingent on more adults getting vaccinated as quickly as possible. So I really hope that people do that because we're all ready to move on from this, and vaccines are the way to do that.
Aren't we just? Doctor, thank you. Dr. Jennifer Nuzzo there, Johns Hopkins Center for Health Security Senior Scholar, alongside Dr. Adalja, making the point, Tom, that vaccinated people shouldn't be tested anymore.
To me, it's a game theory, John. It's just a game theory
Walk
of
us through
vaccination.
that, Tom.
And, well, it's a game theory. You could go to any major course on game theory. I'd start with Avinash Dixit at Princeton in his book, wonderful book, The Art of Strategy. There is a strategy to getting through the process of a new vaccine. We're in the middle of it. And what I would suggest is the major difference here, John, is the speed of news transfer, social media. With the measles in the early 1960s, we didn't have the cable network or the social media to get the angst, the science crew, the non-science crew, into a battle about this. Now we've got that.
Lisa, corporations still trying to figure this out as well.
Well, at what point does COVID-19 move from being a public health threat to something that really is more of a personal response, of a personal tolerance of risk and protection? And that, I think, is the key question. And at what point, for example, can somebody contract the virus and then say to a company, okay, look, it was on me because I could have gotten vaccinated? And these are some of the key questions as companies try to bring people back to work.
We're pretty close to that point
Yes.
in America, aren't we?
We are.
In the United States, at least, the option is there to get a vaccine if you want to get a vaccine.
Well, and I think that Jennifer Nuzzo raised the issue of kids, and that is a big question, especially with some studies coming out with the long hauler types of symptoms. This is a key question, but as we head into the fall, it'll be less of one.
Lisa Abramowicz, Tom Keene, Jonathan Ferro. This is Bloomberg Surveillance with your equity market shaping up as follows. Down 15 on the S&P. We are negative 1/3 of 1%. Yields basically unchanged on a 10-year at 166.59. Euro dollar,
John, you're not
121.96.
Should be quoting Bitcoin.
0.2 of 1%.
Dogecoin.
Do you want to quote it now? You've got 10 seconds.
40,000. It's a currency equivalent.
40K on Bitcoin from New York City for our audience worldwide.
Value add.
This is Bloomberg.
We've never had a situation historically where the Fed has not begun to normalize rates and there's an inflation concern in the markets.
I do worry that after a 2021 boom, we're going to slow perhaps more than people expect next year.
People, they don't like inflation. This is true, but they will tolerate it.
We have a very different set of both market and monetary circumstances and economic circumstances right now.
Make no mistake, there's nothing supernatural about the U.S. economy. We've just given it a lot of extra adrenaline to run on with the fiscal stimulus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures down about 15 points on the S&P 500. Jobless claims about 90 minutes away. Tom, a headline just crossing the Bloomberg comes from the EU Council. We should lift restrictions for vaccinated travellers. We've been talking about this through the week. There's the news, the headline on the Bloomberg.
And just for the authority, Jennifer Nuzzo at Johns Hopkins, this is just clumsy, John, and I don't mean that in a derogatory way. It's just in every vaccine rollout, you go through a process, and the game theory of this is regional, it's geographic, it's cultural, and more than anything, it's about the fear of science. And that's a legitimate societal thing.
Will the U.S. reciprocate? Tom, this has moved very, very slowly. We're getting deeper into summer. We've had a huge trade in the equity market. The airlines have been nicely bid as part of that reopening trade. For the big airlines, they need transatlantic travel back. Will the U.S. reciprocate?
To the conversation David Weston had with that bastion of Delta, the domestic is going to work. Bastion nailed that. But where's the international? And I would suggest, John, just in the last 10 days, there's a huge urgency.
That's the leg of this story, Lisa, that's been missing.
Yeah, the question is, though, we don't know how all the vaccines are working. For example, those, the mRNA vaccines in the U.S. and the U.K. are working very well, where others are used in other parts of the world, do not seem to be having the same efficacy rates. There is a fear of getting it wrong yet again, kind of like how certain countries got it wrong with a lack of testing and lack of travel bans at the very outset of the pandemic. And I think, John, that's slowing down the reopening.
Different countries, different regions, moving at different speeds. Your equity market markets shaping up as follows this morning. Good morning to you all. I'll whip through things just quickly. The S&P 500, a break of 4,100. We're down about a third of 1%. In the bond market, yields unchanged at 166.59. Foreign exchange, euro dollar 121.96. Positive 0.2%. Lisa, just a slightly stronger euro this Thursday morning.
Yeah, people thinking that perhaps that has a bit more room to run, although this is the key question. Well, are we going to see a stabilization here, or will people continue to price in the reopening that we see in the high-frequency data out of Europe? Okay, today, as you said, John, 90 minutes away from U.S. initial jobless claims. Messy numbers, yet still expected to show a downward trend, a gradually improving economy. Although I got to say, more than 400,000 initial jobless claims still at this phase of the reopening with this many job openings. It raises questions about what exactly we're looking at here and what this data does reflect. We'll also be getting the Philadelphia Fed business outlook. Then at 1 p.m., the U.S. is auctioning off $13 billion of Treasury inflation-protected securities. This is very interesting to me to see the institutional demand for a hedge against inflation expectations. Have we seen, to quote you, John, a peak in inflation expectations, a bubble in inflation expectations, or are people going to come in and say, you know what, we need this protection as we face a new regime of growth and restructuring in the economy? And today, we are going to be hearing from U.S. Secretary of Commerce Gina Raimondo talking with a number of CEOs of big tech companies about the chip shortage that we have seen become increasingly pervasive. And frankly, the conversations out of the top chip makers indicate that this will carry on for a longer period of time. My question, John, is how quickly could the U.S. act to really bridge this gap, to really increase production either locally or overseas, to really make it so that cars and iPhones and other devices have some stabilization in the lag time here?
It's been a major issue. We've seen it in the earnings, that's for sure. Evan Brown joining us now, UBS Asset Management Head of Multi-Asset Strategy. Evan, let's start right here. What informs you whether to decide to leave behind the reopening trade or not?
Yeah, it's a great question. I think what we're seeing at this point is, as you mentioned before, Europe improving. We still have room to run on Japan, Asia, and the like, right? Not every country has gotten to where the U.S. is, to where the UK is. And so, we may be at the peak reopening story here in the U.S., and markets may have well priced that. But in other regions, we certainly haven't. You see that in the data in terms of vaccinations and the like.
Evan, I look at all that this is, and what it is a wall of cash. I think we're getting up, some quick number in my head is $300 billion. I can't remember. There's a ton of money laying around. That's what we know for certain. Does it get deployed to quality, or does it get diffused through the market to different allocations and different assets?
Yeah, I mean, there's plenty of money on the sidelines, but also we've had a great run-up. I think on an index level, it's going to be a little bit tricky from here. Investors, I think, are increasingly going to have to go active, look for individual opportunities and individual stocks. And so that is where the money we see going. But overall market index, I think it's going to digest the extraordinary gains we've seen over the last year.
If you do think, Evan, that the reopening trade has largely been baked in the United States, do you think that this idea of reflation and inflation really picking up has been overpriced in markets? In other words, would you say that it's a good time to add duration to buy longer-dated treasuries and go against the grain of the crowd that say that this is actually one of the riskier spots?
No, I think that's a great question. So my basic view is that as much as inflation expectations have run up, we're near record highs in the index. As much as they've run up, there still has to be some risk premium in the rates market, because we don't know, no one knows if these inflation pressures are going to prove more transitory or less transitory, right? And we're going to be going through a few months of data that's going to be quite confusing, like the inflation data that we saw last week. So the markets are going to still have to price this risk premium, this uncertainty that inflation could actually surprise to the upside. And so that's why we still think that that inflation expectations remain elevated from here.
Evan, let's take an asset class. Let's pick foreign exchange. And let's think about the reaction function of each individual central bank for the majors in G10 at the moment. Do you think that's a decent framework for developing a view on the US dollar?
Yeah, I think so. So what we've seen is pretty much every central bank except Australia and the U.S., at least within the G10, begin a tapering process. And the U.S., as we know, extraordinarily dovish. I know people are getting excited about the minutes, but I don't read too much into it. As long as the Fed is intentionally putting itself behind the curve, then that should put weakening pressure on the dollar. Other countries that are both seeing more of an acceleration in the growth pickup, or earlier cycle, and then countries, regions that have begun the tapering process, interest rate differentials between the U.S. and much of the rest of the world should continue to compress.
Evan, I want to go nerdo on you right now. We're going to do this. It's time for some math here. It's Math Thursday. There is a bond-stock correlation which is most unique right now. Lisa mentioned that Liz Ann Saunders of Schwab has really featured this in her work. Part of that is the blessed interest rate parity strategy. It doesn't work when correlations flip like this. What's going on in that space right now?
Yeah, so what we're actually seeing with the bond correlation to the S&P 500 is we've seen that turn from negative to positive very recently. So inflation concerns, yields go up, U.S. growth stocks get hit. But the way we're positioned is quite pro-cyclical. So, and there's still a negative stock-bond correlation between, say, cyclical stocks, value stocks, where we're still getting that protection there. Now, we're super aware that if inflation shoots up from here, you're going to have an issue where bonds sell off and the broader equity indexes sell off as well. That's why we have to be creative with our asset allocations, hedge, be exposed to commodities, have some of that inflation protection, and then in the less liquid space, direct real estate, infrastructure, and some hedge funds, just diversifying that portfolio beyond just 60-40.
Evan, at a time when a lot of pensions still are looking for a 7.5% annual returns bogey, what kind of returns target do you think is appropriate?
It's really tricky. I mean, we've got your standard 60-40 over the next 5 years is earning 4.5%. And yes, it's very true that the expectations of a number of investors is different from what we think markets will experience given elevated valuations right now. So, there's difficult ways to address this. It could be taking more risk, which obviously leaves some people less comfortable. I do think that one of the ways we address this, if those institutional investors can reduce their need for liquidity and can take on some of the illiquidity risk premium, then diversifying into those alternatives, you're still probably going to get better returns in general from private assets here.
Evan, got to leave it there. Send our best to the team. Evan Brown there of UBS Asset Management, the head of multi-asset strategy. How many times have we heard that one at the end there, TK? That if you need some pickup, you've got to go elsewhere and you've got to go into private markets.
Well, that's the pressure right now. Yeah, the private markets thing, that's got its own traps as well. But, John, this correlation idea is really important. Folks, what's important here is John, Lisa, and I all have different data screens. We have our own personal way that we look at the market, always through the Bloomberg terminal. And, John, what I would say now is within the stasis, the word I used with Francine a couple hours ago, that there's just almost a jumble to the correlations on my screen right now.
Yep.
It's odd.
Diversification, the key word here, Lisa. Does 60-40 offer you that right now?
No.
And at the moment, that's the problem.
Well, yeah, at the moment it doesn't. I'm interested in the idea here that actually increasing investment, increasing allocation to private markets could create more volatility in public markets. Because what do you sell when there is a bout of volatility or there's a bout of news? You sell what you can. And that's what we see on an ongoing basis, John.
Treasuries. Liquidity, the most liquid market.
March 2020.
We're talking about that. I think we're going back 10 years talking about that. Maybe longer. What is it, Tom?
It's a haiku.
A haiku.
Treasuries.
Okay.
Liquidity.
Thank you. 8 a.m. Eastern Time. And Milady joining us from Wells Fargo. From New York, equities are down about 14 on the S&P. We're negative about 1/3%. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. In Iran, President Hassan Rouhani says world powers have agreed that economic sanctions on his country's oil and other industries would be lifted. Negotiators in Vienna have been trying to revive a troubled nuclear deal from 2015. Rouhani says they have taken a, quote, major step. The U.S. and Iran have been holding indirect talks. A top EU official said yesterday that the two sides were close to a deal. Israeli warplanes pounded houses, weapons, warehouses, and underground tunnels in the Gaza Strip today. It's an attempt to consolidate gains ahead of what could be an imminent ceasefire, according to the New York Times. The two sides have been discussing a truce that would end Israeli attacks on the Palestinian militant infrastructure. In return, Hamas would quit firing rockets at Israeli cities. And the Democratic-controlled House has voted to create a commission to investigate the January 6th insurrection at the Capitol. 35 Republicans broke ranks with their leadership to support that probe, but the legislation's fate in the Senate is uncertain. Republican leader Mitch McConnell is opposed. Democrats would need 10 Republican senators to vote in favor of the investigation. And U.S. Secretary of State Antony Blinken told his Russian counterpart the U.S. wants a more stable and predictable relationship with Moscow. Blinken met with Russian Foreign Minister Sergei Lavrov in Iceland. He raised a number of issues, including the Syrian civil war and the health of dissident Alexei Navalny. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You know, I'd put us, I don't know, a little bit over 50% being able to do it, but it's going to have to come together quickly. The president doesn't want to wait. I don't blame him there. And so I think the next 2 weeks will probably be the critical time.
Senator Shelley Moore Capito there, the Republican from West Virginia, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Counting you down to the opening bell, 2 hours, 12 minutes away. Equity futures down 9. We declined 0.2%, off session lows, and just climbing back a little bit here. Yields unchanged at 167 on 10s. Got something to say, Tom? That was a deep breath.
But the 10-year, John, to me it is newsworthy tick by tick, but I'm sorry, we've gone 163 to 167 with the real yield move we've seen. You know, everybody's saying it's like dead out there, and I'm saying, well, no, actually, I don't see it dead.
Yesterday wasn't dead. We had a 3-4 basis point move on treasuries, but you didn't want to discuss it.
Look at the real yield right now. You may have to blow up the show tomorrow.
We talked about the taper
0.83.
conversation. You didn't want to talk about the fact they're talking about it.
I was focused on
you had
Doge.
no interest at all.
Well, you know, I had some distractions.
He's hanging with the kids.
Doge.
Yeah.
Do you want to talk to us about Doge, or do you just want to leave that there?
No, Mike McKee has some Doge in his wallet.
He does?
It's next to his Vietnamese dong. He's got dong and he's got Doge.
ATK.
In his wallet.
No.
It's true.
No.
No, it's true.
You have a drink. Stop.
Okay, thank you.
Euro dollar 121.98.
transitory.
Crude 62.64. That was wrong. Carry on.
No, that's a true story. I mean, Mike McKee carries some Vietnamese currency in his wallet and probably is adding Doge to it as well. We are advantaged to digress to Wendy Benjaminson with esteemed politics and study in Washington with a lot of good perspective on where our government is. Wendy, once again, and you and I are far too young to remember 1948. Or even 1967. But once again, we have Israel and Palestine, and always of most interest, the Democratic Party is just a mess here. What does the president do to corral the herd as he tries to get to a ceasefire?
Well, I'm not sure if he's corralling the herd or the herd is trying to corral him on this. You know, the entire time that Joe Biden has been in U.S. government, the America's reflexive position is Israel. We are defending Israel. We are Israel's best friend. They can do no wrong. The trouble is the next generation of Americans is coming up not seeing Israel as a tiny little country surrounded by enemies, but one of the most powerful countries in the region with a very powerful military and a guy Bibi Netanyahu, who's been in power for a very long time. So they see what many on the left and many younger Americans, including Jews, see as an apartheid state, and they want the U.S. to take a tougher position against Israel when it goes after Palestinians the way it is this week in Gaza, even though with the complication of Hamas firing rockets back into Israeli territory. It's much more complicated for Biden than it was earlier in his career.
I agree with the complexities and the change complexities now. What is the actual power projection that any U.S. administration has now over Israel? Because time has moved on.
Well, Tom, that's an excellent point. The United States has a lot less power against Israel than it used to. They have a great military. We provide them with a tremendous amount of military aid. We could threaten to cut that off. They don't have a lot of friends in the international community, and the United States is a big part of that, of a voice that supports them. So losing that could certainly change global opinion about Israel, and I think they want to preserve that, although Netanyahu seems to be ignoring U.S. calls for a ceasefire. So,
Wendy, our discussion of this particular point highlights how much the Biden administration faces a new landscape on a geopolitical standpoint as he engages in his foreign policy. And I'm thinking not just of Israel, but also of Iran. And the talks are continuing between the U.S. and Iran to forge some sort of nuclear deal. We've heard from Russia after their talks that they went pretty well and that possibly they could start lifting sanctions. How realistic is it for the U.S. to reach some sort of agreement with Iran to lift sanctions, allow oil barrels back into the market in the near future?
I think it's extremely possible. I mean, remember, Biden was vice president when Obama struck the deal with Iran and the 6 other countries for the Iran deal. He was a big supporter of it at the time. He's been wanting to get back into it. He's been wanting to show the world that America is re-engaging with the world when Donald Trump sort of pulled us back, into our fortress America. So, now Biden has a chance to re-engage in the things like the Paris Climate Accord and things like that, but also with things like the Iran nuclear deal. This will also anger Israel because, they are very, very opposed to the Iran nuclear deal. They think it means their destruction. And so that's another calculation Biden has to make. But I have a feeling this is going to come together.
Wendy, I got to say, it feels a little bit like Back to the Future with Biden trying to re-engage with this sort of geopolitical regime that predated Trump. And I'm wondering whether Democrats are on board with him. The idea here that some of the protectionism came not just from the Republican Party, but also from Democrats. Can you give us a sense of the tensions within the Democratic Party about this sort of international focus of Biden?
That's an excellent point because, Donald Trump took the Democrats' position that, we would protect American jobs, we would protect. That's a big union position. And Biden has presented himself, and really always has been, a real pro-union kind of guy, the guy from Scranton, the guy from the steel mills. And he very much wants to, as I said earlier, re-engage with the world, but he also wants to protect American jobs. And I think that's part of what the infrastructure push is meant to sort of balance out. The infrastructure push would create jobs, the Biden administration says, and that might mitigate some of the moves back toward internationalism.
Wendy, just quickly, there is a certain irony there because some people would blame the teachers' unions from stopping people from being able to go back to work because they kept the schools closed.
Right. And Randy Weingarten, the head of the biggest teachers union, American Federation of Teachers, said, I think it was just last week, that she was now in favor of everyone going back to school. So the idea is we get through the summer, September comes around, all the kids go back to school, and then voila, the world can fully open again. But yes, that was an issue that Biden had to navigate, wanting to reopen with the teachers unions being very opposed to it. They were afraid of catching COVID. But now that they're all vaccinated, there should be no impediment to starting school.
Yeah. Wendy, thank you. We've got to leave it there. Wendy Benjaminson there, the Bloomberg politics editor. And some people might argue, Lisa, he wasn't that successful at navigating that issue.
No, it has been a very difficult time for the schools in particular. And right now, still, it's very patchy with a lot of schools, mine included, still at home.
Still at home?
Yeah.
Still.
A lot of fun.
Doesn't vacation start now? Summer vacation, isn't that
Actually,
it now?
yeah, they're going to start early, and then they're going to go back to school early to try to regain time. But I've got to say, this has been a year that has been absolutely annihilated for so many kids who have been unable to go to school and actually learn in person.
Tom's living this too.
It's a huge deal, John. John, on that Japanese vaccine thing, I'm as stunned as you are at the slow rollout in Japan. I mean,
Should I read the headline?
I was about to say, did we actually break the news?
Right now.
Yeah.
And
Japan
with the Prime
approving
Minister
the
speaking.
Moderna Astra-COVID vaccines, according to NHK. And when I read that headline, Tom, I was surprised that they hadn't already been authorized. It just gives you an idea how slow some countries are moving.
And how ahead we are. We haven't had enough credit for the success we've seen in selected countries, including America.
Coming up, Bob Miller of BlackRock from New York City this morning. Good morning. On radio, on TV. This is Bloomberg. From New York City for our audience worldwide, good morning to you all. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action this Thursday morning. Equity futures shaping up as follows on the S&P. We're down about 0.2%. Some headlines crossing from Morgan Stanley. It's a shake-up 2 days after a shake-up over at JP Morgan. Ted Pick, the architect of Morgan Stanley's trading revival, and Andy Saperstein, who built the company into a wealth management powerhouse, tapped as co-presidents. And Tom Keene, it looks like Mr. Gorman, is sticking around for a few more years, but setting up the transition for the future.
Yeah, to me, the headline here with James Gorman, age 62, and James Dimon, age 65, is how long they stay around. With Jamie, I think it's sort of indeterminate. It's like 5-ish, 7-ish. It's in the cosmic mists of Park Avenue. For Mr. Gorman, it seems to specify 3 years, so we get a little more specificity on what these successful leaders are going to do.
Sharon Yeshaya will become the CFO, Tom. The CFO, John Pruzan, to become the Chief Operating Officer. A rejig elsewhere as well. All happening in the same week. It's interesting, isn't it, TK? JP Morgan a couple of days ago, Morgan Stanley this morning.
But I would fold it right into the compensation battles at the other bank. What this is about, John, is we're trying to get back to normal. The pandemic's coming to an end, and all this stuff has been delayed 6 months, 8 months, just survival and serious survival with real illness and death, frankly, at these firms. And it's all sort of coming in a wave, and I suggest we see a lot more. What I would focus on, John, is within the firms, it's not the battles, and the media loves, pick against, Saperstein and all that. What I would focus on is the skill sets and the different character and culture of the firms. There is a Morgan Stanley way, and you see that with a kid from Middlebury in Pick, and you see it, frankly, in Pruzan with his commitment from Tufts. Each of these kids has a different culture and past that they bring to this advancement.
Inevitably, though, we'll be talking about the heirs to Mr. Diamond, to Mr. Gorman, and we're doing that this morning. Pick and Saperstein emerging as the likely heirs of James Gorman over at Morgan Stanley. But maybe more crucially for a lot of people waking up this morning and seeing these headlines, Lisa, this from James Gorman, the CEO. He's told the board he plans to remain CEO for at least 3 years. Now, the joke over at JP Morgan is the rolling 5-year view of Jamie Dimon. It's another 3 years for Mr. Gorman.
At least 3 years, even as there is this shakeup just under him. I got to say, you asked the question, John, why now? What is this a coincidence that we're seeing all of these shakeups in the same week? And I would argue it comes ahead of next week's hearings in Washington, D.C.
You're not the first to say this.
I know I'm not the first to say this. I'm not original when I say this.
I'm not implying
so don't worry. I'm
not
going to definitely credit all the people I've stolen this from.
I'm just suggesting that this is an argument that is building.
Yes,
that they're rejigging things going into next week.
And I think that they're trying to take on a more responsible, more diverse kind of view, basically saying we're representing all those different viewpoints Tom was talking about as we reshape banks for a new era, John. And I do think that the reshuffling will play into what they testify.
Morgan Stanley this morning, Tom, JP Morgan a couple of days ago.
Yeah. And I would remember, John, I'd mentioned also that Ruth Port went out to Google here. Mr. Pruzan took over those duties. And, there's been each of these stories is different. No one better at Bloomberg knows that than Sri Natarajan, who joins us right now. To say he's Bloomberg Wall Street reporter barely describes the king of gossip of Wall Street. Who's next? Is Goldman Sachs going to have a shakeup?
Well, Goldman Sachs is one of the recent firms where we've had a CEO shakeup. So you saw that in 2018 when Lloyd Blankfein went out, David Solomon came over.
I need some more fun from these firms. Is Goldman Sachs next?
If Jamie Dimon is going to take 15 years and James Gorman won the same time, I bet David Solomon doesn't want to leave anytime soon.
Sri, the co-president's role. Can we talk about that a little bit more? How on earth does that work?
Well, at least at this firm, it is important that the Morgan Stanley of today is extremely different of the Morgan Stanley from 10, 15 years ago. You have a firm that is not a pure play Wall Street investment bank anymore. Its wealth management arm contributes to nearly 50% of its overall revenue. So it kind of makes sense to pick someone like Ted Pick, who has charge of the entire investment bank, and Andy Saperstein, who's really built Morgan Stanley into a wealth management powerhouse, starting from 2010 with the Smith-Barney purchase through to last year with the E-Trade buy, which was one of the biggest deals, possibly the biggest bank deal since the financial crisis, that it has become a major center of gravity for the firm. So at Morgan Stanley, you had to have a situation, even without any inside knowledge, the best guess anyone else out there would have had was the most logical outcome here in trying to figure out who will be the top deputy to James Gorman would have been these two men in Ted Pick from the investment bank and Andy Saperstein from the wealth management side.
So he wants 3 years. He's told the board another 3 years as the CEO. Many people reflecting on what happened with Citigroup in the last couple of years, where Mr. Corbett said something similar. Then all of a sudden, Jane Fraser just started to move really quickly. Was the Citi situation unique, or do you expect, as some people expected, to see something similar here?
Citigroup and Morgan Stanley, two very different places right now. In fact, Morgan Stanley's market cap is even higher than Citigroup right now. Imagine saying that a few years ago.
Yeah.
That would not have been considerable. Even now, Citigroup has twice the assets of Morgan Stanley. And Citigroup has been going through a number of challenges on the regulatory front and elsewhere. Morgan Stanley is a different story. They are in a good position. They are in what James Gorman calls a position of strength. And when the going is this good, it's hard to imagine you would want to leave. And that's why it makes sense when James Gorman is talking to senior management and the board and saying he wants to hang around for at least 3 more years.
Sri, if you buy the argument that banks are reshuffling senior management ahead of the bank hearings in Washington, D.C. next week, what is the message being sent by the personnel choices, by the moves being made?
I'll have to take the contrarian side here, Lisa. I'm not sure the Morgan Stanley move necessarily signals much to D.C. However, the pandemic could very well have played a role. It is our understanding that James Gorman has been working on this succession plan, at least for a good part of the last year. He does this New Year's resolution every year where at the start of the year, he puts out a list of things he wants to accomplish. And this year, it very much was on the list to make sure there is a smooth transition of power. And that's important for him.
Sri, it's sort of old school to me when I waltz through the biographies of the guys. Edward Pick is a guy who's seen it all. He went over to the equity capital markets side, and then he entered the Death Star, the fixed income shop, which at Morgan Stanley was an absolute train wreck for years. Is he advantaged here because he has equity capital markets and bond capital markets experience?
He certainly does bring big credentials with him. When you say he was started off on the equity capital market side, he helped with the IPO of none other than Google. So he's had some big ticket names that he helped take public. Then he took over the equities business. And in the aftermath of the financial crisis, that was a big challenge to make sure that they could lift Morgan Stanley's equities business. And now it is the #1 player on Wall Street. And then he helped a fixed income business that was flagging. So he's clearly built up the credentials. He's notched up the wins. So his star is certainly very much on the rise.
Sri, tremendous reporting as always, and good to catch up with you, sir. Bloomberg's Sri Natarajan breaking down the news coming out of Morgan Stanley. The top line, the headline, I think, this morning, before we get carried away, James Gorman telling the board he plans to remain CEO for at least 3 years. It's a management shake-up, planning for transition in 3 years potentially. Pick and Saperstein, Tom, emerging as the likeliest heirs, looking at this right now as the co-presidents.
And John, what's so important is when you do this, when you elevate these guys in a certain bracket, one of them is going to be head of strategy. So Simkowitz, I have no idea what a head of strategy does. I thought that was your title, John. But the people come up underneath these guys. So it's not just about the 4 faces on the screen for you on radio.
You know what the cynical would say, Tom? That for the CEO, it's good if they fight between themselves and not with me.
Are you a cynic?
This is
just suggesting that some leaders quite like that situation, especially if you want another 3 years or another 5 for that matter.
I don't know how you succeed without debate. I mean, you got to have debate.
So true, Tom.
And clear through, and surveillance. We're all.
Kumbaya.
Kumbaya.
Is that this show?
This
we're
is
burning
Dr.
sage
Phil
on
incarnate.
set. We got sage
I had no idea
here.
it was head of strategy.
Yeah.
Never told.
VetBill's head of strategy. Robert Miller joins us now with BlackRock, head of America Fundamental Fixed Income as well. He's been watching the deck chairs move at J.P. Morgan, at Morgan Stanley. Bob Miller, are we going to get an announcement out of BlackRock? You want to get out in front of the story?
Really?
I don't think Bob wants to go there this morning. I'm not shocked, Bob.
Bob, I got to talk about yield with you, and I'm going to go full faith and credit right now, and that is the idea of a 163 up to a 167. What is the importance of a rising yield now? What signal does that give?
Well, Tom, the market, good morning, first of all. I hope everybody's well. The market reacted yesterday to the minutes. Frankly, we didn't see a lot of signal value in the minutes, but I think to the extent that the market teased out a tiny tilt toward more people wanting to talking about tapering, that's directionally accurate with our point of view. As you know from my colleague and our CIO, Rick Reeder, who's been quite public about this, and we were very much in the camp that the dual policy settings right now are between monetary and fiscal are disproportionately accommodative relative to the remaining costs associated with the COVID crisis. So we don't expect fiscal policy to be recalibrated. So we're looking for the Fed to acknowledge substantial further progress in a world where many others, including the CDC, who seem to be at the center of the storm for the past 15 months, have acknowledged material further progress with respect to the virus and the economy, businesses, government, et cetera. It's like the one group that has been resistant to acknowledging progress is our own Federal Reserve.
So, Bob, here's the question for you then. I assume from you and the team over at BlackRock right now, this isn't the prudent policy setting, but this is the policy setting right now. So what are the investor implications right now for you?
Yeah, it's a great question, John. So, I mean, for us, be consistent with other things you've heard. We're fairly defensively postured. We acknowledge that if this relatively low vol, relatively tight spread regime persists, we're probably going to underperform a bit. But we think that our fiduciary duty to our clients is to be prepared for some more volatility in the marketplace and be positioned to take advantage of that and eventually accumulate many more assets at much more attractive valuations. So we're a bit defensive. We think we haven't seen the peak in rates. Frankly, I think real rates are substantially lower than fair value. So we're positioned for rising rates, both reals and nominals. We're expecting that the Fed will, in fact, begin to acknowledge substantial progress, and that the tapering discussion will be on the table sooner than the market currently assumes. And it's important to keep in mind we're talking about dialing back emergency policy settings put in place a year ago at the peak of uncertainty, when it's increasingly clear that the emergency is behind us. So we're not talking about like going from uber dovish to hawkish. We're talking about going from uber dovish to a little less dovish,
Bob,
but still really accommodative policy.
Just about 30 seconds left. What does it mean to be defensive at a time when you're expecting yields to rise?
Well, you're short duration in our accounts, and we're holding more cash than we normally would. So we're less, fully invested in credit product, EM, et cetera, places where you would go to find yield, anticipating an opportunity to reload in those asset classes sometime over the next couple of months at much more attractive valuations.
Bob, got to leave it there. Bob Miller there of BlackRock, the head of America's Fundamental Fixed Income. Rick Reeder brought this up with us recently. Russ Kostrick did it again this morning. This cash position, you know what? I brought it up several times with other fixed income investors. I was really surprised about the pushback that I got about BlackRock's cash position going into a summer where most people anticipate there is going to be a taper story developing.
You got a grizzled veteran like Bob Miller there, folks, and, to be honest, a huge respect for people that have been through the ups and downs of the wars. I love what he said at the end, John, about the parlor game, to take the phrase from the Fed, of trying to figure out what to do with higher yield, lower bond prices while you wait to, quote unquote, reload. That's jargon for what do you do in the sweat of higher yields. Mr. Miller's been there.
Bob Miller of BlackRock there on a situation and the cash position they're building going into the summer. From New York City, let's keep things moving. Equity futures down 6. We decline 1/10%. We're recovering.
We're moving.
As the session grows older, we recover.
We're moving.
Yields 166.76.
I need a quote.
Hopefully I'm
on
moving in there at
Yeah.
some point in the next 5 years.
That'll be interesting.
I
This is
like that,
Bloomberg.
Jack. It's hermetically sealed.
As we come to 2021, what we see is it's a mega cycle for compute. I mean, it's like, if you had asked me a couple of years ago, would we have this kind of demand? Whether you're talking about, PCs or gaming products or the data center, I would have been surprised.
Most people would have been surprised, and that was Lisa Su, the AMD CEO from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. 42 minutes away from claims data in America. Going into that, equity futures look like this on the S&P, declining just 7 points now, down not even 0.2%, recovering slowly over the last couple of hours. And the bond market yield basically unchanged. The nominal yield 166.59. The real yield with a big move higher in yesterday's session that TK is going to talk about through the next couple of hours. Euro dollar 121.95. We're advancing there a little more than 1/10%. Euro stronger by 0.16% against a slightly softer dollar. Elsewhere, the news out of Morgan Stanley getting everyone's attention in the last 20 minutes or so. If we can get to the pre-market view of Morgan Stanley right now, 85.80 and down about 1/3%. No big move. This is Mr. James Gorman setting up the transition for the future, telling the board he plans to remain CEO for at least 3 years. Ted Pick, Andy Saperstein emerging as the likeliest heirs, perhaps, Tom, as co-presidents of this company, of this bank.
Bitcoin was stasis here, off the 30,000 level. There we were, John, frozen in time, trying to get to a 29,000 print. We didn't get there, I don't believe. And we're up, we're up 30%. Off the bottom, 40,000, 41,000 now rounded up. David Wilson in treatment did an all-nighter with a Mac computer, the iMac, writing up the visual guide to crypto, and the Bloomberg Visual Guide to Crypto editor joins us right now. You've massaged the crypto stocks, as they're called.
Yeah, absolutely. Just looking at relationships between those cryptocurrency-linked stocks and what's happened in Bitcoin. Now, it's a relatively small period we're looking at here. Just 10 days is kind of constrained by the fact.
For Bitcoin, David, that's long-term.
Yeah, absolutely. I just bring it up because, Coinbase Global just went public last month, so you kind of had to use a short period for this. But what's interesting is that, you think about Coinbase, you can trade Bitcoin, these other currencies. It does not have the closest correlation. What does? MicroStrategy.
That's
yesterday,
a stock.
Yes.
Okay.
I was saying yesterday you were talking about Michael Saylor at length, the CEO of MicroStrategy, the business intelligence software maker.
I'm really up to speed on this.
Absolutely. $2.25 billion invested in the digital currency.
Why is PayPal in there?
Well, because they allow their customers to deal in crypto just as Square does. And Square has a much closer relationship. They've done a bit of investing in Bitcoin, which may explain why the correlations line up the way they do.
And for those of you on radio, Dave's got a glorious bar chart of like 15 stocks here. David, did they all crater yesterday?
They certainly took their hits, no question. But PayPal, since you mentioned it, actually fared relatively well. Let me just take a quick look at where it closed yesterday, because it actually had made back its losses during the day, and indeed up by 0.6%. So, it's really a thought exercise in terms of, all these companies tied into crypto. Where are the relationships?
Yeah, Lee, this is it, Lisa. Come on. He's a thought leader and a thought exercise.
Dave, it's
must
more.
Be Bitcoin.
Hold on a second. It's more than just a thought exercise, because it raises the question of how much correlation is there from Bitcoin to the broader market. The idea that Overstock is one of the more sensitive stocks. That is a company, an online company that sells furniture, not what you would first think of. Square, PayPal, they are payment systems, and they are accepting Bitcoin, so they're more correlated to the crypto asset. At what point does Bitcoin become a systemic risk? We were talking about that yesterday, but this is something that people are increasingly talking about. That, say, a year ago, and this is, of course, what we heard from Michael Shaul yesterday, a year ago it wouldn't have mattered if Bitcoin had a big rout, or 2 years ago, but now it matters to markets.
True enough. I just point out, you mentioned Overstock, Lisa. it has been in the crypto mining business for a while. I mean, they have this unit called T0 that focuses in on the digital currency. So, there's a bit more of a relationship than just the idea that you can actually pay for your overstock purchases with Bitcoin, which in fact you can do.
The Visual Guide to Crypto, we look forward to it. Look for that publication near 4th of July. David Wilson with us, ahead of our stocks coverage there on Bitcoin. John, what'd you learn there?
Just got invited to a mask burning party. Seems extreme. Happening on Thursday, May 20th in New York.
He was paying close attention.
Somewhere else in the Hamptons too.
Yeah.
I was paying attention. I just got that email right now and I thought it was ridiculous. The title of it is Burn Baby Burn, to take the mask off and burn it in celebration. Some people feel that way, don't they?
They do. They feel that, it's really clumsy. I mean, walking around yesterday, John, I did a fair amount.
You didn't know what to do?
Well, I came out of the McDonald's on 3rd Avenue, and I didn't know what to do.
Do you have to put the mask on when you go into some of these places?
Yeah.
I didn't know what to do. I'm with you.
I was ordered.
I walk around without the mask, but when you go into the store, does it go on? Which store lets you do that and which store doesn't?
I'm shocked, frankly, to hear that Lisa's kids are still home from school.
This is a reality for a lot of people, and frankly, I'm sorry, but online school is not the same as in person, and frankly, there are kids who have just missed an entire year of school this year.
So is it the educational aspect, Lisa, or the social aspect you think has been the bigger issue for the kids this year?
I would argue that both, really. I mean, if you take a look at the test scores, they're actually coming down pretty significantly, and people are behind. The social aspect, though, depends on what age and how much people can remain connected versus social media versus younger kids that perhaps need the in-person socialization. I think there has been a dramatic displacement, frankly, for children in this generation. I think that the consequences are going to be vast.
What's the age spread between the two boys? And what's the experience been like between the two of them?
I think that when a kid has more independence and more access to social media, it can be better because it'll give him more socialization, and worse because, frankly, if you're on social media, you feel like you're missing out that much more, right?
Yeah.
I mean, it's not the same as in person, even for people who grew up on that. All right, I'm going to get off my soapbox.
No, it's fine. I mean, you can tell that I don't have children when I talk about the age difference between kids as a spread.
There's
as if it's the bond
yield
market,
gap.
you're long
John, you're
one
so
and short the other.
The yield gap between my 9-year-olds and 12-year-olds is approximately 300 basis points.
Speaking of the bond market, real yields yesterday, Tom. We had a repricing, let's be clear about that. Nominal yields were up about 3 basis points on a 10-year, and it didn't really get many people's attention. But, Tom, the move on real yields, it was real. It was a move from about negative 92 basis points down to the low 80s.
Yeah, what's important here, folks, is we're looking at the nuances here like global Wall Street. And to a lot of people, a 2 basis point move in the real yield is like, big deal, why do I care? But I would suggest, John, there's a lot of people really watching this. And again, I'm going to go where you've been, which is the German 10-year yield is sort of that global linchpin of where are we going or what is not occurring out there, as we've heard from many guests.
And Tom, it's really supported the banks trade over in Europe too. The question mark that I have, though, for the long bank, short bunds trade that's been a great one over the last 6 months or so is whether you want to keep that long banks trade on if Italian yields are coming along for the ride. And Italian yields have come along for the ride over the last couple of months.
And it gets to the ECB meeting, and as Lisa mentioned at the very top of our ordeal today, ECB is frankly more important than Federal Reserve. You can link the bonds right into Lisa here. The convexity of Lisa's offsprings, it's just extraordinary.
It is extraordinary.
When you look at their home convexity.
But the difference is that I don't have kids and I speak that way. You do have
really?
Kids. And you call one cash flow.
Lisa, the way this is we've been getting lectured on children by Mr. Ferro.
And Milady of Wells Fargo joining us shortly from New York. Yeah. This is Bloomberg.
We've never had a situation historically where the Fed has not begun to normalize rates and there's an inflation concern in the markets.
I do worry that after a 2021 boom, we're going to slow perhaps more than people expect next year.
The Fed is likely to start to shift their policy stance in the coming months.
People, they don't like inflation. This is true, but they will tolerate it.
The trouble with a little bit of inflation is a bit like being a little bit pregnant. Things tend not to stay that way.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is a simulcast on Bloomberg Radio and Bloomberg Television. It is a Wall Street back to work near the end of a pandemic. All sorts of different CDC policies and changes on Wall Street as well. With quieter markets, John, it's about a changing of the guard at JP Morgan and now Morgan Stanley.
Let's start with the equity market, down about 0.2% on the S&P 500. We declined just a little bit on the changes from JP Morgan and Morgan Stanley. The real headline here is the leaders, Tom. They're sticking around.
You got that
Over
right.
at JP Morgan, it's still a rolling 5-year view for Jamie Dimon, and for James Gorman, it's another 3 years. At least that's what he's told the board.
But coming out of the pandemic, and the markets are having the same challenge as well, John. We could go 8 ways here on first market comments, but I guess I got to go to finally the real yield seems to turn to a lesser negative yield.
Up 9 basis points in yesterday's session. And what was interesting about that, Tom? Very little collateral damage in the equity market off the back of that move. Equities were down just a touch. They weren't major moves at the index level, let's be clear. And information technology, actually the relative outperformer on the S&P 500, despite that move.
And, of course, we had to disagree, John. Lisa and I just not on the same page. Lisa, you looked at the minutes yesterday and you saw a Fed beginning to chat.
Well, yeah, beginning to chat about chatting. I mean, let's be clear. They're thinking about, talking about tapering. But still, I think it's notable that they are getting a little bit more concerned about the inflationary pressures, and they're trying to signal it. I mean, there is a reason that they put that in the meeting minutes and that they indicated that it was more than just 1 or 2 members. It seems like there is a coalition, perhaps not the core, but on the peripheries joining up. I will say, though, Tom, that this comes at a time where it is very difficult to game out the market. We do agree that this is a very confusing time, and the correlations seem to be breaking down from traditional norms.
What I can agree with John Ferro is looking at 42 charts on the Bloomberg terminal. Jobless claims are a really big deal. They are wonderfully elegant in a constructive trend to fewer claims across America. We see that data in 28 minutes.
Yeah, here's the key line from the key paragraph in those Fed minutes yesterday. If the economy continued to make rapid progress towards the committee's goals. Now, since that particular meeting, Tom, can we say the economy has continued to make rapid progress towards the committee's goal?
Made progress.
Payrolls would scream no. Far more nuanced than just a clean, rapid move through a recovery.
Now, the trend here from 473,000 prior and looking at 450,000. This is weekly data, John, so that is a trend, and anything under 450 would be a constructive shock.
Trend is good. Look, things are good. Things are getting better. The Fed's view is that we've got to take a while, take some time to work these kinks out.
Right.
That we've got this huge demand-supply mismatch, and that with time we will work this out. And yes, higher prices might solve some issues elsewhere, but issues around chip shortages, issues around car rental prices, airfares, all of those things. Yes, there are scope to move higher. There's scope for prices to move higher from here, but they want to give it time.
Can I just say one thing, though?
Please.
And this, I think, is what is getting perhaps the Fed's attention. Mohamed El-Erian came out in a Bloomberg opinion column yesterday, and he said it's clear that worries are growing about the risk of a policy mistake. And it's a risk regardless of what we have seen in terms of mixed data so far. After all, one of the last things the economy and markets need is a late Fed that is forced to slam on its brakes. This is a threat, and it is one that the Fed is aware of, Tom.
Yeah, we're doing it within a boom economy that we've never seen before. There's really been no history. We'll talk about that with an esteemed value guest here in a moment. John, on the data, I'm going to go to the VIX and work off that, where we had a 19 and a big bull market. We pulled back to 27 and a 22.21. I'm going to call that statistic, John, as you mentioned, constructive, given yesterday's festivities.
Yeah, bond market right now on a nominal yield, 166.42. Tom, yields come in almost a basis point. Euro dollar, 122.06, coming in about 0.25%. If the team in the control room could do me a favor, just grab the chart of the City Surprise Index, the U.S. City Surprise Index, and we'll have a quick look at that. Joe Weisenthal brought this up recently. Tom, it's been rolling over. You can have a look at the U.S. Bloomberg Surprise Index as well, and it shows the same thing. Relative to expectations, data in America over the last several weeks has not delivered. It's starting to look like a very different picture, data versus expectations, compared to, say, last year when we just had this incredibly sustained upside surprise after upside surprise because people had continuously underestimated the recovery through last year. This time it's different. The bar is higher, and we're missing that high bar.
No, we're going to get some data here through the week that'll help us with that. And, of course, retail sales here Friday ago, I should say, really helped people recalibrate their GDP numbers. Right now, what we're going to do is look at the equity markets, and we do this through the prism of institutional equity selection. Ann Milletti is iconic at Wells Fargo, out in Milwaukee, where it was strong years ago. She owned the high ground of value. Ann Milletti, we could have a 3-hour conversation here on the efficacy of value. The basic idea is value sits for X number of years, and then it's go, go, go. Can value go moving forward?
Well, look, Tom, it's had a great run, and certainly it's closed the gap with growth, outperforming growth in such a wide, by such a wide margin in Q1 and past that, as you know. The challenge really here is the million-dollar question that the three of you have been talking about so much this morning. Do we really have inflation ahead of us? Or is it something more like, we're in this economy that was shut off with a light switch and is now being turned on with a dimmer switch? And at the end of the year, we actually start to see this booming economy really look more normalized and much slower. And therefore, some of the inflation fears that investors have today really start to kind of moderate. And you then focus on the companies that can outgrow. And so while value is still attractive to our investment teams, there are some stocks in the growth space that investors would kind of call the growth space that are also starting to look attractive to us too, given some of the sell-off and given the fact that those stocks have started to beat, continue to beat earnings estimates and the multiples have compressed. So there's a lot out there, a lot of moving pieces, but this, the recent volatility that we've seen and the recent run in the cyclical stocks in particular has made it more interesting and certainly more of a stock picker's market.
And just quickly, I mentioned the surprise indices that come from both Citi and here at Bloomberg as well for the US. The fact that they've rolled over, that we're consistently missing expectations, what signal does an equity investor take from a picture like that?
It's interesting because you see on one hand a lot of expectations being beat, and then there's some economic data that has lagged a little bit more. So, you've talked about what the Fed is probably paying attention to, wage growth, employment, the rent prices, et cetera. And those things haven't necessarily, surprised on the upside. And so those are the main focus points, I think, for the Fed when they look at long-term inflation. And that's kind of what they're focused on. Investors, however, see and hear from companies all of the pressures they're seeing with commodity costs, with transportation costs, all of these things that longer term will compress margins if they don't get solved. And I think they worry that spillover effect, if the economy stays as strong as it is, fueled by all of the stimulus that was put behind it, you get inflation in those scenarios.
Well, and this is one reason why a number of investors have come on the show and they've said they're looking for companies that have pricing power, that can raise their prices on consumers effectively without denting their sales. That's something that you reiterated in recent research. How much has that already been priced in, though, that these companies do have that power and thus are attracting that much more investor attention?
Yeah, it's a good point, Lisa. Certainly our investment teams have been very, very focused on pricing power over the last quarter. To Tom's point earlier, the cyclicals and the value space, as you go into a recovery phase of the market, that's the place you're going to get a lot of bang for your buck early on. But the longer the cycle continues, the more careful you have to be about where the staying power is for that pricing power. And so our teams are now, rather than it be an industry or a big, part of the market that's going to get that pricing power, it's really more company by company who can sustain it. And that's what they're really paying great attention to.
And thank you. Great to get you on the show. and get your input on the market. And Melessi there of Wells Fargo. A couple of big central bank meetings coming up next month. June 10th, the ECB. June 16th, the Federal Reserve. On the ECB, on this Standard Chartered piece that's just been published by Steve England to Tom, let's just read this line. If we were asking questions at the press conference, I think this is a nudge to the journalists out there, we would ask them to specify how much disinflationary impetus they see from, say, just throwing it out there, a 5% stronger euro. Interesting debate brewing.
Well, it's a debate brewing, but John, we've also seen that. We have experience over the last, I'm going to say 18 months of moves out 122, 123. And what I've noticed, John, is people were originally framing out at 130, and that's come down and down and down. Everybody's getting a lot more sensitive about where that dialogue really engages.
Deutsche Bank and Goldman looking for something in and around 125. A range of views, a range of time horizons, obviously, with those views. Q4 21, looking at FXFC on the Bloomberg terminal. Your median forecast, Lisa, 121
Yeah,
on
so
euro dollar year end.
one of the key questions is the fact that the ECB has signaled greater willingness to talking about tapering sooner than even the Federal Reserve. This idea that the Fed is lagging behind other central banks even though the U.S. economy is doing better than these other regions. What does that do to the currency? Does that lead to a stronger euro, or do we not necessarily see them reiterate this?
Not my view, but UBS and Evan Brown looking at the individual reaction functions from different central banks and suggesting with your framework that means a weaker dollar. And that's the view from the team over at UBS Asset Management right now. Equity futures down 6 on the S&P. We're down a little more than 1/10%. For our audience worldwide, claims data in America about 20 minutes away from New York.
Doge is trading.
Thank you, Tom. Doge is trading. This is Bloomberg.
Evergreen.
With the First Word News, I'm Ruchika Gupta. Morgan Stanley CEO James Gorman has unveiled his biggest leadership shakeup in more than a decade. Gorman positioned a small group of executives as his most likely successors. Ted Pick and Andy Saperstein were named co-presidents. Dan Simkowitz will become co-head of strategy, and CFO John Prizam becomes chief operating officer. Gorman is 62 and has run Morgan Stanley for 11 years. In Iran, President Hassan Rouhani says world powers have agreed that economic sanctions on his country's oil and other industries would be lifted. Negotiators in Vienna have been trying to revive a troubled nuclear deal from 2015. Rouhani says they have taken a, quote, major step. The U.S. and Iran have been holding indirect talks. A top EU official said yesterday that the two sides were close to a deal. Israeli warplanes pounded houses, weapons, warehouses and underground tunnels in the Gaza Strip today. It's an attempt to consolidate gains ahead of what could be an imminent ceasefire. According to the New York Times, the two sides have been discussing a truce that would end Israeli attacks on the Palestinian militant infrastructure, and in return, Hamas would stop firing rockets at Israeli cities. The Democratic-controlled House has voted to create a commission to investigate the January 6th insurrection at the Capitol. 35 Republicans broke ranks with their leadership to support the probe, but the legislation's fate in the Senate is uncertain. Republican leader Mitch McConnell is opposed, and Democrats need 10 Republican senators to vote in favor of the investigation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
Whether that's the South China Sea, the Arabian Gulf, and increasingly the Arctic. It's of vital interest to America's foreign policy to secure unimpeded flow of global commerce.
The President of the United States there, Joe Biden, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures about an hour and 12 minutes away from the opening bout. Down 7, we're negative 0.18%. Claims data 12 minutes away. Your bond market with yields coming in about a basis point, 166.25. Euro stronger. We reclaim that 122 handle, Tom. 122.06, up about 0.25%. That's a stronger euro.
Yeah, churning market. We wait 12 minutes for claims. John, I do want to note Bitcoin finally gets a movement here. We just had a 42,000 print, so that's 39,000 to 42,000 off the 30,000 base in the ugliness yesterday. You get lucky on Bloomberg surveillance when you have a changing of the guard or a deck chair movement at J.P. Morgan. at Morgan Stanley to have Robert Albertson join you. He's with Piper Sandler and chief financial strategist. What he does do is write the best deck on the street. It's 60, 70 pages, but he does it every week, every month, whatever, like Mary Meeker does once a year. We're thrilled that Robert Albertson, student of global and American Wall Street, could join us this morning. Robert Albertson, all of these banks, the institutions you followed for decades, are in search of a strategy. There's going to be lots of strategy analysis, focus groups within the bank with all this new talent to get out to a new financial strategy for the next 5 years. What is that strategy going to be?
Technology, finding ways to maximize the use of technology for all manner of reasons, customer satisfaction, earnings, bottom line strength, things like that. They all, no matter where they come from, are going to get their feet wet in technology.
Tell us your weighting of the typical banker, equity, fixed income executive versus a wealth management executive versus someone in consumer banking that is front and center on technology. Which shop is advantaged by those three different kinds of executives?
I would say all of them are. The one that is more obvious is consumer banking, because it deals in the retail sector with a variety of ways of making things efficient without having to have a branch. But you see technology coming out now in the trading area that wasn't there before, certainly in the wealth management area that wasn't there before, even small and medium-sized business. All the pieces now are getting technological injections, if you will. And I think even the smaller banks are going down the same path.
Robert, there's a question of whether you invest in technology or whether you acquire technology, whether you acquire smaller companies that are on the vanguard of some of the tech advancements in the financial services industry. Which do you expect to be the predominant way that banks try to get into certain streams of technology that they're not in currently?
They're going to acquire the technology and install it. I think that's the answer. There are plenty of neobanks and purely fintech banks that will be successful. But I think the fight is going to be on just getting the technology in place, particularly for the larger banks, so that they can compete. So I guess what I'm telling you is I think the basic banking sector will live another day.
Which of the major banks, Robert, is the most behind when it comes to the technological advancements in finance?
I'm not allowed to talk about individual banks.
You could just say what it rhymes with. Well, I guess, would you say that most of them are pretty well adapted, or are there major deficits?
Yeah, certainly the larger banks are well adapted. I would say as you go down the scale, the places where you see trouble, in my mind, are banks that are operating on very old core legacy systems that are very costly because they break down all the time. That's the only obvious danger.
Robert Albertson, I've noticed it, and just a joy to have you on as we see these two banks restructure. Everybody's restructuring in Asia, and it's all centered around wealth management. Obviously, Morgan Stanley with Saperstein's elevation focused on that with their success. And the cycle is we're cutting, and then a year later we're expanding, and we're cutting and we're expanding. The cyclical action in Asia that we see among the American banks, is that constructive?
No, I think it's so far more disjointed up until now. I think that one of the places in the world where you have to be consistent the longest to be successful has to be Asia. And those who come and go or are revving it up and then backing off are probably creating problems for themselves.
How much, Robert, are you paying attention to the hearings in Washington, D.C. next week, where the CEOs of these finance companies go before Congress?
Well, obviously, I'll be watching for the tone. The one thing I've hoped for from the Biden administration and the appointees he's made so far is that we stop any more war on the banks. They performed very well during the PPP period. They have enormous capital. They're really a clean bunch. And so I hope it doesn't break down into another one of these tar and feather games that sometimes happens when banks go to Washington en masse and sit in front of Congress.
It's politics. Got to expect it, haven't you? Robert, good to hear from you, sir. Robert Albertson there, Piper Sandler, Chief Financials Strategist. Let's reset, guys. Your equity market looks like this. We're down 7 on the S&P, down about 0.2%. In 6 minutes' time, jobless claims data in America. And the claims data we're expecting to see is a better picture, relatively speaking. We're looking for 450K, down from 473,000. The team at Bloomberg, Olivia Rockman and Reed Pickett, writing a nice piece this morning on the 20-plus Republican states, Tom, that have removed emergency unemployment benefits, the unemployment insurance, the additional unemployment insurance that was offered by the relief package that's been passed recently. Tom, we're about to see whether that helps alleviate that big gap between demand and supply. It's a real-world test that's going to play out in America in the next couple of months.
In the next couple of months. I don't know if we're going to see it in the next 6 minutes here, John, but clearly everybody's going to be watching that. And again, I want to state this. There's been a lot of good work done on this by the University of Chicago, and they show state by state there are huge discrepancies.
The reason I raise this, of course, is because we will break the economic data, and then we're going to have a conversation with a senator from Montana. And this is where this started.
Yeah, absolutely. I mean, Steve Daines is living it out there in a state with very, very low unemployment. And there's serious constraints here, John, in manufacturing and, frankly, in agriculture.
8.12 million, the job openings in America, Lisa. 8.12. It's a lot of open jobs.
And the idea here is that there are different costs of living in each state, right? So the cost of living in Montana is very different than the cost of living in Tom Keene's Manhattan. And the idea here is that people are earning more from the unemployment benefits. I am wondering, though, at what point companies will respond first. You're seeing them offer more money. You're seeing some offer money just to show up to an interview. I'm just saying.
I think also it's worth saying it's a dangerous game to pick one reason to say why there is that demand-supply gap right now. There are so many in this economy. From New York, we're 5 minutes away from the claims data. We'll get the price action, the data itself, and the political reaction in just a moment. On radio, on TV, with Tom, Lisa, and John. Beautiful. This is Bloomberg. From New York City for our audience worldwide, good morning to you all. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Jobless claims data just seconds away. Here's the price action going into that. Equity futures right now down about 1/3% on the S&P 500. We're down 6 points. In the bond market, yields come in about a basis point to 165.57. Euro dollar, positive euro dollar. Euro stronger, dollar weaker. Euro dollar 122.04. Here are the numbers. The right kind of downside surprise. 444,000 is the number. 450,000 was the median estimate. 473 was the previous number. Getting the Philly Fed business outlook as well, coming in at 31.5. The survey 41.5. That is the wrong kind of downside surprise on the Philly Fed business outlook. The previous number 50.2. So Tom, jobless claims coming in just a little bit here. 444 down from 473 and better than expected. The median estimate 450, though we can say that's basically in line. And your price action, the market reaction to this, equity futures have been erasing the losses of the morning over the last couple of hours. We're down a little more than 1/10%, maybe call it 0.2% on the S&P. And in the bond market, yields come in just a couple of basis points to 165.
A mixed idea there with claims doing better than expected. Philadelphia Fed, as you mentioned, a little bit lighter. I'm going to call it a churn searching for more data, John.
Yeah, and I would go with that. But that Philly Fed business outlook, Lisa, does that get your attention?
It does get my attention. I'm wondering how much some of the supply chain delays, some of the higher material costs that we've seen reported across the board seem to be stymieing some of the outlook by factories that are meeting incredible demand. And I do wonder how much that could slow growth or sort of put sand in the kinks of the recovery, John.
Yeah, just getting some revisions to the previous month on claims as well. So I'll bring you that and then we'll move on. So 478,000 revised to a previous 473 to 478. The number 444. The number's decent compared to what we were expecting, what we were looking for from the previous month. Continuing claims, just with a kick higher, just a little bit of a kick higher on continuing claims.
Numbers.
At least I think a lot of people are struggling with claims. And I think claims has been the head fake for people plugging that into the payrolls estimates too.
I mean, that's the reason why I sort of put an asterisk around it every time I talk about it now, because what can we get from this? We have lower than expected initial jobless claims, but higher than expected continuing claims that actually increased from the prior week. How do you make sense of this? And I just say, you know, it's viewed as a very noisy data point, and that's why I was interested in what the Philly Fed data was.
So to wrap it up, Tom, claims coming in better than expected, just a little bit. The trend is still decent. It's got to get better. Philly Fed business outlook much softer than anticipated. But the story is 8.12 million jobs available in the United States right now, openings, and we've got this demand-supply gap that we need to try and match.
And the geographic gap as well. We are focused, of course, at our world headquarters here on all the tri-state area, maybe what the East Coast is doing, like the Philadelphia Fed business. There is another America that is truly a boom America. We talk to senators, we talk to congressmen and women, sometimes manufactured. Steve Daines of Montana is the real deal. He is original Montana, growing up in Bozeman, chemical engineer from Montana State University, weaned there within Republican politics, and the senator joins us this morning. Senator Daines, as Montana's government site says, Montana works. What are you going to do with a 3.80% unemployment rate?
Well, I'll tell you, a big shout out to our new governor of Montana, Greg Gianforte, who has been a friend of mine for 20 years. We were in business together in the cloud computing business for 12 years. Greg understands how you make economies work, how you create jobs, and Montana was the very first state that eliminated that $300 a week supplemental federal unemployment insurance benefit. Because when you take a look at the state benefit plus the federal benefit, it was about $17 an hour to stay home. This isn't about folks being lazy. This is about logic. You just look at what you could make going to work versus staying home, and you could make more by staying home. Greg stepped out a little over 2 weeks ago and said no more of that. 20 states now have followed Montana's lead. What we have right now in this country is primarily a labor crisis, not a job crisis, as evidenced by the 8.1 million jobs available right now.
You know, you go down to the Western Cafe in Bozeman, Senator, and that's where you're going to actually learn what's going on. What is the anecdotal evidence you or the governor see right now in Montana after this decision was made? I mean, it clicks in late June, I believe June 27, but what have you observed with this policy action?
Well, you're talking about the Western Cafe. I'm getting homesick. That's inside baseball there. But if you go to the Western Cafe or go up and down the main streets across Montana, you're going to hear a couple of things. First, help wanted signs everywhere, now hiring everywhere. My wife and I were in my pickup driving by a small business recently in Montana, and there were balloons all around this business. I thought, what's going on? It looked like a car lot or something. There was a tent set up with people inside. They were doing live radio hits. It was a hiring promotion. They were trying to find people to work. But here's one of the anecdotes we've already heard in Montana. We've had a business there in Helena that was seeing 1 to 2 applicants every few weeks prior to the governor's action to suspend these federal additional benefits. After that happened, they saw 60 applications come in within the first 72 hours. So it's early, it's anecdotal, but we're going to keep an eye on that. Clearly, I think we're going in the right direction here of creating incentives to get back to work.
Senator, you clearly believe this is the right policy for the state of Montana. Do you think that applies to the rest of the country?
Well, governors will make that decision, but I think generally anytime you are paying people more to stay home than to go to work, that's a problem. And I think it does depend certainly whether it's an urban versus rural kind of situation as well. So within the states, there may be differing kinds of incentive issues going on. But again, I think I come back to common sense. When you have these very generous benefits that were needed for a time, when we hit that crisis last year, it was the right thing to do. But you can't keep paying people more to stay home than to go to work.
Clearly, people find this an intuitive argument. What do you make of the argument that perhaps because children haven't been able to go back to school in many places still, that's held back participation in this labor force?
Yeah, no, I think that's a fair point, and I think it's important that there's just not one thing we need to do here to continue to get folks back on the job. I think the child care issue is a very real issue. That's why it's so important we get the schools opened up and kids back in the classroom. Parents are upset. They want their kids back in the classroom. They learn better in the classroom, and it allows mom and dad to get back on the job if they need to do that.
Senator, when I think of Montana, I think of the CCC back in the 1930s, which helped shape Yellowstone National Park, one one of the key national places that really represent America's natural history. I'm wondering, from your perspective, whether you're becoming more open to the idea of something akin to that, some sort of work program or some sort of infrastructure spending that goes beyond just fixing certain bridges and tunnels at this point, given where we are in the economic cycle.
Yeah, well, I've chaired the National Park Subcommittee for the last couple of Congresses, so I'm a big fan of our national parks. We've spent a lot of time as a family in the wilderness areas in our national parks as people who love the outdoors, as so many Montanans do. But I think fundamentally, first of all, remember, we passed the Great America Outdoors Act under President Trump in a very strong bipartisan vote, which really was targeted infrastructure for our national parks, as well as funding the Land and Water Conservation Fund. So we've already, I think, made a down payment on infrastructure for national parks, badly needed, to repair some of really the fraying edges of our national parks. But I think stepping back on the infrastructure question, I think we need to come back just to define what infrastructure is. It's roads, it's highways, bridges, waterways, broadband, airports, wastewater systems, and I think there's room for a bipartisan compromise if we really define infrastructure as kind of the man or woman on the street would say it is, not some of these social programs, free community college, free daycare, that the Biden administration is saying that's part of infrastructure.
What size bill would you like to see with that bipartisan plan? We've heard a headline number of about $800 billion.
Yeah, I think there's a range somewhere, probably in the $500 to $800 billion range. That's still a huge amount of money. I think we've been desensitized as we've been talking these trillion-dollar numbers now over the last year and a half. Remember, these are it's massive amounts of spending, and I think we all have some concerns about what inflationary impacts that might have on our economy to our long-term detriment. So I think we want to be measured. But we also want to address the issue that infrastructure is an investment in America. I view that more as investing than spending. We'll get a return on that investment.
Senator Daines, you've been a supporter of President Trump and much of his policy as well. You need to look forward to 2022 and 2024. I want you to find common ground with a retiring senator from Ohio, Rob Portman. Is there a place for a diverse future Republican Party, or is it going to be the party of Trump?
No, there's absolutely a diverse party. Rob Portman's a very good friend of mine. I was a Procter & Gamble guy for 13 years, of course, headquartered in Cincinnati. And Rob used to work in ranches during the summer in Montana as a kid growing up. And so Rob and I go back a long ways. I have the utmost respect for Rob Portman. But no, there's room here for a Big Ten. I mean, at the end of the day, politics is about addition, not subtraction. And we are stronger when we have those diverse views within the Republican Party.
So what should be this? I don't mean to interrupt, Senator, but I think this is absolutely critical. What would you like to see from the former president to bring a more diverse Republican Party together versus his 909-page statement to two attorneys in New York yesterday? What does President Trump need to do now?
Yeah, well, I'll tell you, if you think about what happened over the course of the last several years, the president brought so many blue-collar workers into the Republican Party. They weren't necessarily political or partisan. They really don't care if there's an R or D behind their name. They wanted to see this America first, protecting manufacturing jobs, bringing jobs back to the United States. And in so many ways, he expanded the party, as well as with Cuban Americans, with Hispanics. You actually saw very strong numbers in this last election. That's part of the untold stories, the actually inroads with minorities that was made by Republicans and led by President Trump. Now, I understand that some folks don't like some of the mean tweets and other things, but take a look what's going on right now in our economy with these policies, with what's going on. Biden canceled the Keystone Pipeline. At the same time, he's greenlighting the Nord Stream 2 pipeline and help Russia. I mean, you can't make this up. And so these inconsistencies, I think, are going to cause a real problem for many voters who are, I think, going to have some remorse of what they decide to vote for President Biden in 2020.
Well, we'll see in the midterms in 22. Senator, let's end this conversation by teeing up our next conversation, and hopefully we can do that in a couple of weeks' time. Bringing Europe along for the ride for the foreign policy goals of this administration and this country has proved difficult over the years on both China and Russia, with Nord Stream 2, as you mentioned. Senator, your priorities, how they set up with that in respect, with regards to that?
Yeah, well, of course, the Europeans are incredibly important allies, and both in terms of economic allies as well as from a national defense and with NATO and so forth. But think about what's going on right now. We're importing. The United States is importing more oil from Russia as we speak here today than Saudi Arabia. The Keystone Pipeline oil would more than replace the Russian oil that we're importing. and why President Biden would kill that project, that pipeline, while at the same time, we've heard now, green-lighting the Nord Stream 2 pipeline, lifting those sanctions to create greater dependencies for Germany and Europe on Russian natural gas. I'll tell you who's cheering right now. It's the Kremlin. And that's a real problem as it relates to not just short-term but long-term geopolitical implications.
Senator, I think we'd all love to get you back soon, so let's find some time in the diary over the next couple of weeks and we'll pick up on this conversation, sir. The Senator from Montana, Senator Steve Daines there. From New York City, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Coming up on the Open, Morgan Stanley's Global Head of Macro Strategy, Matthew Hornback, on this bond market. And they're talking about it over at the Federal Reserve. From New York this morning, good morning. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. The price of oil fell after Iran's President Hassan Rouhani said world powers have agreed to lift economic sanctions. Negotiators in Vienna are trying to revive that troubled nuclear deal from 2015. Rouhani says they have taken a major step and the main agreement has been reached. Iran's already preparing its oil field so it can ramp up exports if sanctions are eased. Billionaire Barry Diller's $260 million Little Island opens tomorrow in Manhattan. The 2.4-acre park is a platform of grass, trees, and winding pathways mounted on concrete paths where Pier 54 used to be. An amphitheater seats almost 700 people. Throughout the summer, the Little Island will host various concerts and festivals. Diller picked up most of the cost of the Little Island through his Diller von Furstenberg Family Foundation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
Bloomberg Surveillance. Good morning, everyone. Lisa Abramowicz and Tom Keene, John Ferro preparing for the arduous task of the Open. Rumor has it Bitcoin will move as John starts the Open at 9 o'clock. Right now, the esteemed coin, $42,000. Frankly, Francine, excuse me. I had Francine on the brain because Francine got this lovely dog, and I was like thinking about the puppy. Lisa, when I look at Bitcoin, the fact is it's moved 30,000 to 42,000. That's impressive.
It is impressive. It's also impressive how you can toggle between Francine, a dog, and Bitcoin. I will say that this is sort of this big question for institutional investors, which is how do you invest in an asset class that moves around this much, 30% in a day?
Well, we're going to get to that in a moment, but right now we're going to rip up the script, and we can do that with one Troy Gajewski of Skybridge Capital. Folks, I'm going to give you a window right now into wealth management. Here's the fact, and Troy, you know this well. Wealth management is razor-thin bond margins, almost razor-thin equity margin, and everybody's dashing around looking for what used to be called a 6% business. A 6% business is some form of set of transactions where you actually make real money like the old days, and that works around alternative investments in wealth management. Troy, you deal directly with Morgan Stanley and wealth management. What does it mean to your world to see Andy Saperstein receive the accolade he's received today from Mr. Gorman?
Oh, yeah, it's tremendous. I mean, Morgan Stanley is our largest client. We think the world of Andy and his team, Ben Heineke and Jeremy Beal, who we typically interact with. And it's just so rewarding to see the strategic decision that Gorman made years ago to really focus on wealth management and watch them grow into the powerhouse they are today. So we're super happy for Andy and his team.
Okay, you love him. You're happy with him. Guess what? We don't care. Here's what we want to know, Troy. What we want to know, Troy, is a 6% business going to be there for Mr. Saperstein and the minions that replace him? I mean, the fact is, over 20 years, there's been this search for that kind of beginning margin. Will it evaporate in the next 5 years due to competition?
Well, look, so I think in terms of asset returns, right, which is the principal driver of revenue, right? When you think about wealth management businesses, it's fees off of assets, and you grow assets two ways, through returns or through raising capital. We all know that given that equities are 21.5 times 2021 earnings and bond yields have come up a bit, but are still, near generational lows, every asset allocation model has lower expected returns going forward, which is one of the reasons why those platforms focus on alternatives. Like we're obviously biased towards those like ourselves, but also structured credit or areas in illiquid fixed income, and even, dare I say, alternatives like Bitcoin, for instance, right? So, the wealth management business is always evolving. It's never easy, but the tailwind from hyper loose monetary policy obviously will fade over the next several years. And it's going to be much more of a grind to generate that, 6% return, as you say, Tom.
All right, so let's talk Bitcoin, because when you came on this program a couple months ago, you said that you had built a Bitcoin portfolio that grew to about 13%. Then we saw these wild gyrations over the past week. Have you changed your view in any way on the crypto asset?
Yeah, so look, I think this is why it's so critical for every investor in whatever asset class you take risk in to have a thoughtful investment thesis. And thoughtful investment theses can go wrong. But let's step back, Lisa, right? Look at the macro environment, right? We're still growing money supply at 16% annualized. We have more than 30% money supply versus pre-pandemic. We don't agree that the dollar is going to debase into the Atlantic or Pacific Ocean, but over time, one of the key ways to get out of debt traps is to inflate your way out of it. And unfortunately for the Fed, there's been more asset inflation than real economic inflation. So the macro environment is very favorable. We're still very early in the halving cycle bull period compared to the last cycle. So unless the halving cycle suddenly becomes meaningless, it's just very unlikely that this is a shorter bull market than the last one. And then thirdly, think about the adoption cycle, right? The last bull market, there were no institutions, no credible hedge funds, certainly no sovereign wealth funds or corporate treasurers looking to allocate to the space. And even yesterday, right, what came out? Wells Fargo, which is more of a bank and less of a broker-dealer like Morgan Stanley, they're going to be offering a product to their clients. So when we look at the three legs to the thesis, there's still hold. The surprise, of course, is that instead of getting a 20 to 30% pullback, we had a north of 50% pullback, which is certainly an eye-popping amount of volatility. But we've already seen, the market find stability, big whales step in and provide a floor. And so it's almost as if Elon Musk never got involved, right?
Well, but Troy, hold on a second and stick with that, because this is part of the issue, right? Is that Elon Musk tweets and there is a market response. There is a regulatory push over in China that wasn't necessarily new. There is a market response. Have you changed your allocation at all based on the volatility that stems from these idiosyncratic perspectives, these idiosyncratic tweets and guidance?
No. So again, we still think that it's unfortunate that one person could have so much control over one market. We definitely concur with that criticism. However, right, when you think of the three keys to the stool or of the thesis, right, they're still very much in play. And it's still our best performing allocation so far this year, even after, a 30, 40% dislocation. So again, the key is whatever size at cost you're comfortable with, let the bull market play out. Tolerate the volatility, and have confidence that ultimately by the end of this year, you'll be at a meaningful higher price, and then keep reevaluating versus the macro, versus the halving cycle, and versus the adoption cycle. And all three of those still point to green light go.
Troy Gaske, thank you so much. With Skybridge this morning, and particularly thank you for your comments
Lisa.
on Morgan Stanley. Lisa, I just looked at the claims chart, and it's just truly elegant. It's like teach your course trend base to a better statistic. It may take some time to get there, but the fact is it is a gorgeous chart towards a better job economy.
Look, we are in a recovery, and certainly with the vaccination rates in the United States, it's hard to see how that could be materially disrupted, at least as we move out of a pandemic era, as we move to Amish Adalja's post-pandemic reality of COVID-19 being treated like the flu. However, I do wonder about these job openings and the fact that you're still seeing such elevated jobless claims, people who are filing anew for jobless cost benefits at a time when you do have all of these openings and anecdotal evidence saying that they can't get candidates in really raises some eyebrows.
Well, you wonder back to a fully employed America. Some people, not all, are predicting that. But how many will be unemployed even if we get to a so-called fully employed America? That was a fairly large statistic in February, ages ago.
And there's a question of how much the economy has transformed during this period of time to a more technological economy.
Yeah.
Different skills.
Really, really interesting observation is the permanence here that we see. And I would say, Lisa, in a broad technology, it's not just the obvious Amazon and cardboard boxes, but you're right. We really don't know the structural changes there.
And you're seeing anecdotally companies retraining workers who are on the front lines of, say, customer service into technological roles. Are you taking coding classes, Tom?
Yeah, I'm learning Python to get through.
Yeah, Python with vet bill.
The next cup of coffee as well. Speaking of technological changes, an electric vehicle Ford F-100. James Farley will explain, the Ford Motors CEO, conversation with auto guy David Weston. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.